Welcome back to the European Market Open. A minute to go until the start of cash equity trading. I'm Francine Lacqua here in London with Danny Berger.
Here are your top stories. Evergrande shares are halted pending news about a major transaction. China's embattled developer is said to have guaranteed a bond that's just matured. OPEC Plus meets. The alliance will discuss its production policy today amid rising crude prices. And Boris Johnson says Brexit Britain must adapt amid fuel and food shortages. We're going to be live from the Conservative Party conference.
Now let's take a look at the futures, and you can see we're seeing a little bit of pressure on the DAX futures, down some 0.2%, really a similar pressure across the board. Now the focus is on Evergrande, as Danny was saying. Danny, the other focus, of course, on the worries about stagflation. So this is not only inflation, but it's actually lower growth. We spoke to a number of market participants saying, look, central banks do have the tools to deal with it as long as they act now. Unclear exactly what that will happen. And then here in the UK, we look at the Tory party conference. We're expecting them to do a lot more for the labour market. We're also expecting something possibly nuclear when it comes to Brexit and the Northern Ireland Protocol.
Well, you'd have to imagine all of that is making UK assets not exactly the most attractive, Francine. Well, look, we are opening up. We basically only have the FTSE 100 open thus far. And as you're saying, it is not doing well. It's declining about 0.2%. Of course, it's not anything really dramatic here, but it is more than Spain. For example, the IBEX just opening as well, down 0.2%. But we're expecting France and Germany to be the most under pressure. At least that's what our future boards were indicating. So we're looking at France, the CAC 40, down 0.5%. So it could be a lot of these larger companies that are feeling the pain. Remember, these are the type of companies that have to contend with supply chain issues, that have to contend with higher energy prices. How is that going to filter through to their margin? How are investors going to treat it? Well, you can see this morning it means we are seeing a lower market. Now, we are looking at a weaker pound and a stronger euro, so that can, of course, have effects in terms of these equity markets as well. Just want to point out as well, France opening down 0.2%. So, of course, we're waiting on Germany, which the futures board did indicate that that was moving lower. Let's get a quick look on the sectors as well. Energy has really been the outperformer for some time now, and we are looking at energy up 0.2%. Andrew Garthwaite over at Credit Suisse says that if we are in a stagflationary environment, what you will see is energy be the sole sector to outperform. So as we're looking at these markets open up today, keep that in mind as we're seeing just energy being the only sector that can really continue and consistently move higher. Banks under pressure, down 1%. They had been doing better with a steepening of the yield curve. Perhaps that trade is seen as being overdone. And autos under pressure as well, down 0.6%. For autos, Francine, it is always those supply chain concerns. We have warnings out from company to company. So it's going to take a lot to really improve this sector at the bottom of the pile here.
Yeah, it certainly is. Now, European markets, of course, opening a little bit undecided about the direction of travel. Investors continue to assess the risk to growth and the potential impact for more persistent inflation, as Danny was saying. So here's the view of Mohamed El-Arian, chair of Gramercy Funds Management.
Inflation isn't going down. Inflation is hot at the core level. And you know what? If you do the pure statistical calculation, it's very unlikely they can get to that target. So they're going to be revising their end-year target up yet again.
Well, joining us now is Ben Gutteridge, Director of Model Portfolio Services at Invesco. Ben, what do you do with inflation right now? Is it temporary, as central banks are at pains to tell us, or actually will it really run hot, much hotter than we think?
Well, good morning. I think we're sort of in that transition phase about how we're assessing inflation, to be frank. I mean, I think our working assumption is probably still on balance, that these transient inflationary pressures should fade. You know, we'll get the labour market supply replenished as people return to work. You know, get those Chinese ports reopened, and supply chain issues in relation to gas and other energy sources resolve themselves, and so inflation should settle. But of course, we are seeing a broadening of inflationary pressures. I think if you look at that trimmed mean inflation, you know, you take out some of the outliers, and you're starting to see more inflationary pressures are sort of across the board. And of course, those wages, the all-important wage numbers, are at the upper end of a comfort zone. So, you know, probably on balance, thinking inflation is transient, but you've got to adjust portfolios to the increasing risk of more persistent and stickier and higher levels of inflation.
Okay, so how do you then rebalance your portfolio to account for a possibility of, as you say, stickier inflation?
Well, I don't think we need to get panicked out of equities just yet. I do really believe that the central banks, even though we are seeing, you know, a marginal move away from emergency policy settings, and of course some central banks, you know, initiating taper and indeed interest rate rises, but that major act at the Federal Reserve, I do still think is a long way, you know, 12 months plus from raising interest rates. So that should, although we can get volatility in the short term, that should settle fears about, as I said, moving away from equities. But within your equity allocation, if you have a growth orientation as we do, then you know, I think you've got to be looking to rotate to some more value plays. You know, real estate, commodity type businesses, even financials. You know, on the back of a rising interest rates, a steepening yield curve. You know, those sorts of moves seem to be the sensible ones at the margin at the moment.
Ben, so what does it mean for actually how you model a portfolio? Do you know, how much cash do you have in there? How much gold do you have?
Well, I mean, that really depends on, you know, the risk of the client, but we like to stay fully invested. So I don't think we're really being aggressive on cash at the moment. But I'm afraid, given the means in which we can invest, actually gold doesn't sort of isn't a particularly sensible option for our types of clients. But all of that being said, you know, I still think, you know, within the fixed income component, you've got to be working that harder, looking at more alternative type assets, whether it's infrastructure, whether it's private credit, whether it's real estate. You know, that it's that component, those natural diversifiers in the past, that you've really got to be working a bit harder. And I'm sure gold can play more of a role for those who can invest in that asset class.
All right, so this is good to know when we're talking about cash on the sidelines. It certainly isn't you, Ben. I do wonder, so you're talking about leaning towards perhaps some more cyclicality, value, certainly, but when we've looked at the rotation that the market has done in the past week or so, it's really been energy, it's been financials. It hasn't been those sort of classic value type sectors, things like materials. What does that tell you about what the rotation will look like as we close out the year?
Well, I mean, the materials sector does have this, you know, rather big Chinese real estate story to deal with, and that could yet weigh on performance for those parts of the value sector, those typical sort of cyclical parts as you highlight. You know, I think we sort of all agree this isn't a Lehman moment, but that doesn't mean it can't be pretty bad. And so, while it might not be our base case, you know, a break on the real estate sector or within China, you know, could continue to be a bit of a drag on materials performance. So you still have to be selective within the value parts of the market. But yeah, I think you know, financials and energy seem the more sensible ways to achieve exposure in those parts of the market.
Ben, it seems like the UK is imploding for a number of reasons. This is a lack of drivers, unclear whether tax will rise again. And of course, then if the UK unilaterally changes the Northern Ireland Protocol, you don't exactly know how the EU will retaliate. What are you buying, if anything, in the UK now?
Well, some pretty emotive language there. Well, I think in the UK, I think we can still get comfortable with, you know, like retail names and financials and the more cyclical elements. Of course, we do have that, you know, the big materials component that we've just talked about that leave us a little concerned in that area. But actually, you know, the UK economic picture At an aggregate level, of course, there's lots of troubling stories, but actually growth is okay. The labour market is looking in decent shape and actually, you know, may be able to cope with this sort of the closure of the furlough scheme. So that does support consumption and spending power. Of course, whether they'll be able to spend it on all the things they want is another issue. But on balance, I think, you know, the cheapness and the cyclicality of UK equities, you know, looks reasonable at this stage.
All about finding those good value wins. Ben, thanks so much. You're going to stick around with us. That's Ben Gutteridge, the Director of Model Portfolio Services at Invesco. Francine, I think you're going to have to tell Tom that he needs to ask someone there at the Tory conference about the UK imploding for a variety of reasons. I might raise a few eyebrows.
Well, let's say it's not going to plan.
Yes. Very
right?
diplomatic way of putting it.
Diplomatic way of doing. No, if you look, it's interesting actually. A lot of the banks have said, look, and you know, I know you asked about whether the pound was, trading like an emerging market currency, and actually there are many more banks saying, you know, just if you look at it from a data point of view, the volatility that we've seen in the last 3 to 4 months, there's something more bigger underlying, and it is trading at the margin like an emerging market currency.
Exactly. I mean, this inflation question, of course, is a problem in Europe, but the fact that it's so acute in the UK, I think really goes to emphasis that as well. Well, up next, we're going to be talking about China. You have Evergrande woes growing. Shares in the troubled Chinese firm are halted in Hong Kong amid reports of a major transaction. We're going to have more on that next. This is Bloomberg.
What have we learned from this Evergrande crisis so far?
From my investment perspective, I think diversification is very important. So far this year, we see many events, right? Maybe in the fintech sector and education, casino, and property. So I think diversification help you lower your risk on your overall portfolio.
Medium term, though, are you seeing more risk and reward in the high yield space in Asia? I mean, how are you viewing this right now? Are there actually buying opportunities given just the selling we've seen?
This time is a bit different in the property cycle because in the last, when you see there's a tightening measure, there's always demand there, right? Just the government trying to suppress the demand. But this time we're seeing a confidence issue, is like a buyer strike. Because of the sentiment, the Evergrande is hurting the sentiment, and people don't want to buy. And other developer, because they want to get cash.
How did you make the decision to move to the Bahamas of all the options out there?
We've been looking at the Bahamas for a while. They're one of the first countries to roll out any comprehensive regulation for cryptocurrencies, which we think is extremely important for the space and a really positive sign.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
I support the new framework.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Welcome back to the Open. 12 minutes into the European trading day. A little bit of pressure still at the margins on a lot of these equities. If you look at the Europe stocks 500, actually practically unchanged. The focus on Evergrande, the focus, of course, on the UK, unclear exactly what will happen, also with that Northern Ireland protocol. And then we focus on growth and the fear of inflation, which would lead to a stagflationary environment. Now,
All about those stagflation fears for sure. Well, Francine, I want to kick us off with some stocks that are on the move. The first one being Morrison's. This is the UK grocery chain. There has been just this knockout fight to see who can take it over. Well, we finally have the winning bid. It comes from private equity fund CD&R beating out Fortress. It's bidding £9 billion for it. Perhaps the price was lower than had been expected. The winning bid is 287 pence a share. Previously, the stock had closed at 297. So just the fact that a lower bid won means that the share price, Francine, is falling, even though it is going to be going private.
I'm looking at IAG. This is the parent company of British Airways, getting some 1.5%. The focus, of course, is on some of the travel restrictions being lifted just in time for half term, with relooking at some of the red list countries. So that's giving a nice little lift to some of these companies, including IAG, gaining 1.5%.
Yeah, and finally, I have a real estate company for us. This is a German real estate company called Adler. It had just last week been trading at its lowest since March 2020. Well, now it is mulling the sale of some German residential assets. It's had interest from potential buyers as well. The company said in a statement it could sell material parts of those residential assets in Germany. So selling them, getting some revenue, which would pay down debt and return capital to shareholders, means people are bidding up the stock today, up more than 4%, Francine.
Now, one of our top stories, Evergrande's shares have been suspended in Hong Kong, along those with the property management firm. Now, that's after reports that Hobson Development would acquire a stake in the latter unit. Our chief China markets correspondent, Sofia Orta-Costa, joins us now. So, Sofia, good morning. What's the latest? China seems to be looking to ring-fence the company.
Yes, exactly, Francine. It's been a very fast-moving story today. Let me just tell you how our day went over here in Hong Kong as we followed the story. So we heard that the shares were suspended at request of Evergrande. Now, this is very rare. Evergrande last requested a share suspension in 2016, and it hasn't done so, obviously, throughout the whole debt saga over the past few months. So we knew something big, something material was going to happen. And then the local media called Xiaolian, a financial news platform, reported that Evergrande was nearing a deal to sell a 51% stake in its property services unit. Now, this is its crown jewel. This is a company that is more profitable than Evergrande itself, even though it has only a fraction of Evergrande's revenue. And the report said that Evergrande was going to get about 40% premium for that stake, which confused all of us. And then, a few hours later, the local media report was amended to show that the price was actually very different, showing a 28% discount to market value when the shares last traded on Thursday. It was a holiday here in Hong Kong on Friday, Francine. So let me just wrap that up for you. Evergrande, what we know is Evergrande will disclose a material transaction today or in the next few days. Its shares are suspended. It might be, it looks like it will be a sale of its crown jewel, at least a stake in the property services unit at a discount. Now, if Evergrande is selling its most valuable asset at a discount, how else is it going to raise money? It will really struggle here, Danny.
All right, Sophia, thanks so much. That's our Sofia Orta-Costa in Hong Kong. Still with us is Ben Gutteridge, Director of Model Portfolio Services at Invesco. So, Ben, we were just talking before. You said Evergrande, not a Lehman moment, but it has been affecting materials and real estate stocks globally. Does that mean that you want to go in and buy some of these equities and some of these assets that are perhaps now underpriced based on this reaction to Evergrande?
Well, I mean, to a degree, that depends what your starting position is. I mean, if you haven't got any, yeah, I'm sure it's well worth having a hedge against a better outcome. I think that would be the catalyst for that would be, a larger scale Chinese stimulus than we might be expecting. But the reason we're not expecting that is because those rounds of stimulus in the past that have so helped the real estate market have also boosted or widened that income inequality. So we are expecting stimulus to offset, economic contagion and the worst sort of possible economic outcomes. But our core view isn't that we get a large-scale stimulus, and so those types of stocks, those types of sectors remain in the sort of throes of volatility in markets. But of course, there is some cheapness over there. There's some cheapness within that sector over the long term. But in the short term, if you've got some, I probably wouldn't be adding.
Ben, what do you make of, I know you were talking about financial stocks a little bit earlier on. How much do we know about their exposure to China and possibly something happening that's ugly with Evergrande?
Well, I mean, that's a great question. I mean, from what we can garner from the level of transparency that we can get out of banking institutions is that there isn't too much exposure for us to worry about, and sort of developed market banking stocks, for example, should be able to move through this, notwithstanding the challenge that a slowing real estate sector may have on global growth. But of course, there could yet be, I don't want to call them hidden gems, do we? But these hidden assets on balance sheets that are difficult to read, we could certainly be surprised negatively in regards to the amount of exposure. But I think it's sensible to believe that developed market banks can move through this crisis relatively unscathed.
Yeah, hidden gems. Well, whatever the opposite of gems is there, maybe. Ben, thanks so much for joining us this morning. That's Ben Gutteridge, Director of Model Portfolio Services at Invesco. Great to have you on this morning. Now let's get over to the Bloomberg Business Flash. Here's Angel Feliciano. Hi, Angel.
Hi, Danny. Tesla has seen a new record quarter with a better than expected 241,000 deliveries worldwide. Wedbush analyst Dan Ives calls it an eye-popping number. Quarterly deliveries is one of the most watched indicators for the electric car maker and is widely seen as a barometer of consumer demand. A whistleblower at Facebook has accused the social network of putting profit ahead of the well-being of users. She's passed thousands of internal documents to U.S. lawmakers and the Wall Street Journal. The former product manager gave her first public comments to CBS's 60 Minutes.
Someone else might have just quit and moved on. And I wonder why you take this stand.
Imagine what's going on inside of Facebook, and no one on the outside knows. I knew what my future looked like if I continued to stay inside of Facebook, which is person after person after person has tackled this inside of Facebook and ground themselves to the ground.
Wall Street titan Jamie Dimon has ended up defending his pay again. The JP Morgan CEO gave an interview to Axios' HBO program. He told them the board decides what he makes, adding it's part of a broader package designed to retain senior management. JP Morgan paid Dimon $31.5 million for 2020. The interview also focused on the bank's pledge to help combat racial inequality. And that's your Bloomberg Business Flash. Francine?
Angel, thanks so much. Angel Feliciano there in London. Now, coming up, progressive Democrats are looking for ways to rescue President Biden's stalled domestic agenda, opening the door to scaling back some social spending. So we'll have a full roundup of U.S. politics and the impact on the markets next. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Who are U.S. Open tennis champion Emma Raducanu's three dream dinner guests?
Daniel Ricciardo, Michael Jordan, and Tom Keane from Bloomberg.
She understands you.
Funny and very understandable.
I am reading in on tennis like nobody.
Champion approved Bloomberg surveillance. Mornings on Bloomberg Television and Radio.
Welcome back to the Open. We're about 23 minutes into European trading day, mostly a negative day, really being led lower by the biggest equities. So some of those large cap stocks in the DAX and CAC alone leading us lower. DAX there lower by about 0.5%. Same with France. We are seeing some outperformance when it comes to the very bottom there, but otherwise we are mostly seeing a negative day. Now to the US, and progressive Democrats are trying to break a stalemate that's holding up a vote on legislation for $550 billion new spending on infrastructure. It's supposed to be a major component of President Joe Biden's economic agenda. House Speaker Nancy Pelosi has set October 31st as the new target date to pass the stalled bipartisan infrastructure bill.
I'm telling you, we're going to get this done. It doesn't matter when. It doesn't matter whether it's in 6 minutes, 6 days, or 6 weeks. We're going to get it done.
Joining us for more is Bloomberg's Bruce Einhorn. So, Bruce, Biden there saying, we're going to get it done. It doesn't matter how long it takes. Are there any signs of progress in indeed getting it done?
Yes. So the key thing to keep in mind is that the infrastructure bill is something that President Biden wants to pass along with the bigger reconciliation bill. That's the one that has his plans for health care, for education, child care, climate, all of those things. So the bipartisan infrastructure bill is something that is passed in the Senate. The House, Nancy Pelosi says, will pass it we'll vote on it by the end of the month. But in order for that to happen, they need to have agreement on the bigger reconciliation bill. That's the one where we're seeing signs that there is some negotiation taking place. So, for instance, over the weekend, we saw that Alexandria Ocasio-Cortez, AOC, the prominent progressive in the House, she said that it's possible that we can get the price tag down on the $3.5 trillion bill by limiting the amount of benefits or the time frame for benefits. That would help to reduce the cost. That's really important because Senator Joe Manchin has said that he wants the bill to be closer to $1.5 trillion. He's not going to go for 3.5.
So, Bruce, how does this get unlocked? And actually, how quickly do we need to wait?
Yeah, I think we're going to be waiting a while, to be honest. Given that Speaker Pelosi has now said that she's not going to have a vote for the infrastructure bill until the end of the month, that gives them time to get things worked out on this bigger healthcare, education, climate, all of those things. So it's going to be a while, I think.
All right, Bruce, it's going to be a while, and I know you'll be staying on top of it for that long while. That's our Bruce Einhorn. Thanks so much for joining us. Now, coming up, Euro area finance ministers gather in Luxembourg amid the worst energy crisis the union has seen in years. We're live in Luxembourg with our Maria Tadeo next. This is Bloomberg.
there is just a lot of demand right now for products, whether those be items for our home office or for backyard entertainment. This has been a consistent issue for the past year or so throughout various lockdowns. The global supply chain is made up of ships and trains and trucks, and it's designed for predictable patterns of demand, which is the exact opposite of what we have right now. A lot of uncertainty about whether certain economies are going to be open or closed based on the outbreaks that they're having. So we're just seeing a lot of confusion, a lot of chaos, and a lot of uncertainty disrupt the whole system. The auto industry is very reliant on semiconductors, these memory chips that are in basically everything we buy that has sort of an electronic component to it. And they come from certain economies in Asia like Taiwan, where they're having trouble meeting the demand. The supply chain issues are going to be around as long as you think the virus is going to be around. First or second quarter of 2022 is when a lot of people see the normalizing of all the shipping and transportation disruptions that we're seeing. But if they don't, we might be dealing with this for another year or two or three.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Welcome back to The Open, everyone. 30 minutes into European trading day, and here are your top stories. Evergrande shares halted pending news about a major transaction. China's embattled developers said to have guaranteed a bond that's just matured. OPEC Plus meets. The alliance will discuss its production policy today amid rising crude prices. And Boris Johnson says Brexit Britain must adapt amid fuel and food shortages. We'll be live from the Conservative Party conference. Now let's get straight to the markets. A little bit of pressure, Danny, across the board.
Yeah, definitely. Europe is underperforming. We did have a better futures session in the U.S. Let me take you over to the board, Francine, and show you exactly what they're looking like this morning. So we definitely are seeing DAX, CAC 40, any of the sort of large cap indices do seem to be underperforming today. So you have a DAX that's down 0.7%, France down 0.9%. Doing better is the FTSE 100, but I should say it's moving deeper into the red as we continue on to our trading day here, about 30 minutes into our trading day. So overall, on a headline basis, your benchmark European stocks down 0.6%. It's really this energy story, what inflation means for earnings, company growth. Morgan Stanley, Mike Wilson over there, saying that the inflationary story, the hit to margin pressures because of these supply chain issues are not properly being factored into prices. Well, here we go. Here's your sector breakdown. At the very top here, we have healthcare, food, beverage, and tobacco, and utilities. What do these three have in common? Not only are they all in the green this morning, but they are just those classic safety type sectors. If you're worried about a market on a day, these are the type of equities that you're going to end up buying. On the bottom, we have banks, we have autos, we have technology. So really interesting mix of things that people are selling off. It is extremely clear with only 3 sectors to the upside this morning, Francine, that the breadth is to the downside, that people are worried and they're selling things like banks, autos, and technology.
Danny, back to our top stories. Of course, it's a global energy crunch. We're watching 2 events today. First, OPEC Plus meets amid signs that the oil market is tightening.
The recovery will continue. It may be slow. It may be bumpy. But we are on the path of this positive trajectory.
Demand for jet fuel is going to pick up. At the same time, we're going into winter, and we don't have enough gas to keep the world warm, and that's going to lead to a surge in demand. So it could potentially happen sooner, the $100 oil.
We still have a long way to go, but next year is probably going to be a lot stronger for travel, a lot stronger for oil demand.
All the risk is shifted to the upside, so we stick to our $80 target with potential risk $5, maybe even $10 higher than that, depending on what kind of winter weather we get.
Generally, in the oil business, when prices are so high, people begin to invest more, and then you create the new cycles.
Well, in Luxembourg, Euro area finance minister gather as gas shortages threaten the bloc's recovery. Now, for more on both of these, we're joined by our energy reporter, Helen Robertson in London, and a reporter in Luxembourg, Maria Tadeo. So, Helen, let's kick it off with you. What's going on with China's energy consumption, and how is that actually impacting the rest of the world?
Hi there. So China's energy consumption has surged recently, and that's essentially because its industrial activity has ramped up. And that's as it's emerged from the pandemic. China's really struggling to get enough energy. So coal, for example, it grew to record prices last year. It's paying sky-high prices for liquefied natural gas, and that's having a knock-on impact on the rest of the world. And it's exacerbating a supply crunch that we have in Europe already. So gas and power prices in Europe have just keep surging past record after record. And so, I mean, analysts are now expecting that it's going to be a pretty tricky winter for us, especially as inventory levels are so low. Analysts estimate that Europe's gas storage levels are at a decade low.
And then, of course, another knock-on effect are oil prices, the price of Brent hovering around $80 a barrel. Helen, OPEC Plus meets today. You've been staying on top of that story as well. How might the global gas crunch impact their policy when it comes to oil production?
So OPEC have up to this point indicated that they're likely to continue with their gradual measured increase approach. However, they are under now increasing pressure from the gas crunch, basically because analysts are expecting that demand for oil is likely to increase, basically as competition intensifies for other types of fuel, so coal and gas, for example. So obviously, if that happens, prices are likely to rise, and OPEC will be under continuing pressure to release further barrels in the market. The thing with that, though, is that the group is likely to be quite hesitant, cautious, shall I say, in doing that, because they're not going to want to derail all the hard work that they've done in rebalancing the market.
Helen, let's also go to Maria, who's in Luxembourg for us. And Maria, good morning again to you. Just how big a concern is this for Europe, especially as energy demand picks up? Will we see further caps on prices?
Yes, Francine, and this is probably going to be the #1 issue when finance ministers meet here in Luxembourg for a number of reasons. Of course, as you alluded to there, we're seeing benchmark prices for both electricity and gas in Europe hit a record high pretty much on a daily basis. Finance ministers worried that this could derail and remove some of the momentum in the European economy, but they also think in terms of the inflation picture, whether that could feed into prices too on a bigger scale. And you know, there's already a big debate as to whether this is sticky or is just temporary. The other issue, as you also mentioned, Francine, is the social impact that a lot of this will have. We have seen European governments take actions to cap the prices when you look at the wholesale and the way it's translated into households. We know that today, in particular, the Spanish will put a proposal, a measure, so that European countries buy gas in bulk. Now, it doesn't mean that it's going to happen anytime soon, but the sense that we get is that, yes, European governments are prepared to take more measures, and two, that they want to see collective buying in order to get some of the leverage power that some of these companies have on an individual basis and have a much bigger say in those transactions. So yes, it's still very much top of the agenda. You could see perhaps some of that tension between the companies and governments heat up as we enter the winter.
All right, so as you say, this is a political issue as well. You have policymakers taking action, especially in Spain. What about when it comes to the relationship of Russia? How is Europe going to approach this in terms of getting more energy flow in there? Has there been any conversation about that, or will there be, do you think, at this finance ministers meeting?
Well, you know, Danny, there are two things to the story, or two different narratives. One, of course, is that this is about the European economy picking up. This is demand. And then there's the supply issue. We know that Russia has been running a very tight ship on that front. And we know this is still a very political story for the European Union, in particular when you look at Germany, the Nord Stream, and Vladimir Putin. Now, this will, again, increase calls in Europe that there should be less dependency on Russia. And then secondly, also when you look at the green transition and how we switch from fossil fuels into the greener economy, there's also concerns that perhaps this is showing some of the limits to that transition, that this is a transition that A, costs money, but perhaps may need more time. So again, it feeds into two parts of the debate, whether or not we can hit those targets when it comes to the green, and then two, whether or not Europe should be diversifying, perhaps even going into nuclear when it comes to their energy mix, as you see the limitations of the current one.
All right, thank you both for joining us. Our energy reporter, Helen Robertson, in London, our reporter in Luxembourg, Maria Tadeo. Now, coming up, Jobs Aid on its way. The UK Chancellor is set to unveil a jobs plan as the country faces a cost of living crisis. We're live from the Conservative Party conference in Manchester next. This is Bloomberg.
Of the Greek economic debacle. What were you thinking about to make Greece recover as it has?
Well, Tom, we took over in July 2019 with a very clear mandate to make the economy grow again. We were hit by the pandemic, but we still managed to implement very significant reforms. And I think we used the fiscal room that was available to us to support the real economy. We're very encouraged by the recent data. The economy grew 16.2% in the second quarter of this year. We revised our forecasts upward to 5.9%, and this may be a pessimistic forecast for 2021. We see lots of interest for foreign direct investment by American companies, European companies. We're making big progress in digitizing the state. We have a very ambitious green transition plan. And overall, I think the mood in the country after 10 years of crisis has significantly changed.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
Welcome back to The Open, everyone. We're 40 minutes into the European trading day. Danny Berger's confusing me, talking about espressos or actually lattes with coconut milk. That is a whole other conversation.
They're delicious, I'm telling you.
I mean, maybe this is a future. After Oatly was valued at like 10 billion because of oat milk, coconut milk may be the next one. All right, we digress. European stocks under pressure. European stocks down some 0.5%. They're worried about, of course, China. They're worried about inflation turning into possible stagflation if we don't have the growth. Pressure building on the ruling Conservative Party as it holds its annual conference. The UK Chancellor Rishi Sunak set to unveil a £500 million jobs plan as the country braces for a tough winter. Now, the government faces growing concerns over fuel shortages and a cost of living crisis. Our very own Tom McKenzie spoke to the CBI President, Karen Bilimoria, earlier this morning at the Tory conference in Manchester.
Desperate times are now where we do need not just lorry drivers, it's butchers, it's welders, it's in the hospitality industry, it's across the board that there are labor shortages. And so if we can address them from a temporary point of view, that would help the situation. But of course, the long term, you've got to reskill. At the CBI, we've estimated 9 out of 10 people will have to reskill over the next 10 years.
Well, Tom is now joining us. Tom, I mean, first of all, the Prime Minister, trying to respond to labor shortages, also about pig culling, which was a little bit surreal at times in that interview with Andrew Marr. And then we have the Chancellor also saying, that kids will have their Christmas presents.
Well, this just points to the pretty dire backdrop for this Conservative Party conference, the first one since 2019. The ruling Conservatives facing this laundry list of very dire problems that is really hitting home for drivers and households across the country. It's the second week for that panic buying at petrol station. Now, Rishi Sunak has said just in the last few minutes that he thinks that is starting to ease. Of course, the energy crisis, this is not just a UK story, it's a European, it's a global story, but certainly you've seen utility companies here closing, you've seen households seeing their bills go up as a result, and in many supermarkets across the country, as a result of these labour shortages, you're seeing empty shelves. So that is the backdrop as you come into this Conservative Party conference. It is Rishi Sunak, it is the Chancellor of the Exchequer who will be giving his speech just before 12 p.m. But you're right, it was the Prime Minister on Sunday who was pushing back on any short-term fixes to alleviate these labour shortages that are underpinning what's happening in the forecourts when it comes to petrol, but also the supermarkets and the delivery as we lead up to Christmas as well. He was saying that there's no short-term fix. This is a post-Brexit adjustment. He wants to see a high-skilled workforce and a high-wage workforce as well. So pushing back on pressure and calls from some to further relax the curbs on foreign labour coming into the UK.
Tom, I have to say, in your interview with Karen Bilmoria in the last hour from the CBI, one of the things that I was pretty surprised to hear was for him to bring up stagflation. I mean, you know this, looking at markets, this is a concern that's starting to come into the fore. How common of a conversation is this being had at the Tory party conference? I know we hear from Chancellor Rishi Sunak soon. Is this really present in the mind of people as they consider where the UK goes from here?
Well, how can it not be, right? And it's got to be on the mind of the Chancellor, Rishi Sunak, given that the UK arguably is closest to this conundrum and the pain of stagflation than any other economy. And as you rightly say, there's a debate amongst economists as to whether we are there, whether it is likely. But certainly you've got an inflation picture that is its highest in 9 years. You've got the Bank of England's Andrew Bailey saying that the recovery, the growth is starting to peter out now. You have these labour shortages. So that potent mix, that toxic mix of slowing growth and higher inflation is something that obviously policymakers and Rishi Sunak front and centre will be having to wrestle with. He's going to be giving a speech just before midday. The question of stagflation will be on the back of his mind, but he's also going to try to address the question of jobs and getting people into work after the end of that furlough scheme at the end of September, and that £500 million that is expected to deploy to ensure that you can re-skill workers. That is also going to be, by the way, what the BOE is going to be watching as well. You know, Danny, you've been watching this, the market's pricing in 2 rate hikes in 2022 because of the inflationary pressures here, but economists also saying that, look, the labour market is going to be watched very closely as well by the BOE on the back of the end of the furlough scheme that supported these 11 million workers, whether they will be able to fill these labour shortage gaps or not and reduce some of these pricing pressures that we're seeing here. By the way, the Chancellor as well will also be trying to give a nod to foreign investors to reassure them about the UK and it being an investable destination.
But at the same time, Tom, we're hearing from the Telegraph that actually the UK has drafted a plan to replace the Northern Irish Protocol, which, you know, some would say is the nuclear option.
Yes, so we are expecting to hear from Lord Frost. He was, of course, the chief negotiator, I believe at around 9 a.m. UK time, so in a little under 20 minutes or so. And there have been reports, you're absolutely right to say, that he will threaten to trigger Article 16 and end and suspend that Northern Ireland Protocol. Of course, that would not go down well at all in the halls of power in Brussels. We're also hearing that the Europeans themselves are set to present their own proposals, their own changes to the protocol after this party conference next week as well. They are very reluctant, of course, in Brussels to renegotiate this Northern Ireland Protocol altogether, but this is an issue that remains unaddressed. Ultimately, the transport, of course, of goods from the United Kingdom into Northern Ireland and then through to Southern Ireland as well, the island of Ireland. So that question remains. We will hear from Lord Frost, we believe, later this morning.
All right, Tom, thanks so much. That's Bloomberg's Tom McKenzie in Manchester for us, staying on top of the Tory conference. And Francine, we're reliably told that Tom's choice of coffee is a Pret across the street. I'm going to find someone to send him a coconut latte.
The coconut latte. I can't wait to try. I don't know whether if you manage to like turn me into coconut lattes, I think I'll have to hand in my Italian passport.
Yes,
no matter.
Okay. Be prepared to turn it in. Be prepared. All right, let's get over to the Bloomberg First Word News with Angel Feliciano. Hi, Angel.
Hi, Danny. Japan's parliament has appointed Fumio Kishida as prime minister. He's set to reveal a new cabinet lineup as he looks to revive support for his ruling party. Local media says he's likely to call a national election for October 31st. Kishida was not the public's top choice for the job, so now he has to win over voters. New COVID vaccines will be needed next year. That's according to the head of vaccine maker BioNTech speaking to the Financial Times. He says a new formula will be needed by mid-2022 to protect against future mutations of the virus. He's warning new strains may emerge that can evade booster shots and the body's immune response. Police searched Credit Suisse Zurich offices last week in a raid related to the Greensill probe. That's news from which the Swiss bank managed a group of investment funds. The bank says it's cooperating and the police action isn't targeting Credit Suisse itself. And a massive document leak has revealed how world leaders and the super rich hide money in offshore accounts. The International Consortium of Investigative Journalists has dubbed the almost 12 million files the Pandora Papers. They say beneficiaries of secret accounts include Jordan's King Abdullah, former UK Prime Minister Tony Blair, and former associates of Russian President Vladimir Putin.
This is a different leak from what we've seen before because, for example, in the case of the Panama Papers, the investigation was based on one offshore provider in Panama. In this case, we have information coming from 14 different service providers and law firms around the world from many different jurisdictions, from Cyprus to Seychelles to BVI, etc. And so this investigation and this leak really tell us how the system works, and it's not just about how one company operates, but really how offshore finance works across borders.
Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Francine.
Angel, thanks so much. Angel Feliciano here in London. Now, coming up, Evergrande's troubles grow. Shares in the troubled Chinese firm are halted in Hong Kong amid reports of a major transaction. We'll dig deeper into that with our Markets Live team next. This is Bloomberg.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Welcome back, everyone, to the Open. 52 minutes of the European trading day, and we're still on the downside. A little bit of pressure as we wait to find out what happens with China's Evergrande, and of course, as we wait for more news on possible stagflation and growth prospects. Also, the Tory Party conference here in the UK going on in Manchester. Now, let's take a look at some of the stories we've been following this week, and this afternoon, we'll get US factory orders for August. On Tuesday, French industrial output numbers are out. On Wednesday, it's Russia CPI. Details of the data could determine the size of the next interest rate hike.
Then on Thursday, we'll be scouring the minutes from the last ECB meeting on its decision to scale back bond buying as the economy recovers. And then on Friday, we have U.S. jobs data, the latest figures on non-farm payrolls. So a lot for markets to digest this week, and a lot for our Bloomberg and Live's Nora Ali to digest as well. She joins us now. Nora, thanks for joining us. So I feel like the concerns around Evergrande did recede a little bit as we really concentrated on the energy story. I'm wondering, have we lost the plot? Should we be paying more attention to Evergrande in terms of the spillover effects at the moment?
At the moment, I'm going to say no. I think we're doing very well, juggling everything else on the side. And we also have the OPEC Plus meeting later today. So our calendar and dockets are quite heavy. In particular, when it comes to Evergrande, I think this is good news. This is them trying to figure out what's going on in the situation. It's a double-edged sword situation, unfortunately, because they are apparently, according to the reports that were a little bit confusing as well, selling at a 28% discount. And so that's not a really good news to their holders of that property, the listed property company that they've got. But realistically, this is them trying to handle the situation, and that's the best thing that they've got at the moment. So I think we'll wait and see there.
Nora, what are you expecting for, oil? And again, there's a read across actually between oil and gas prices. What will OPEC do?
Well, realistically, I think OPEC is sitting at the cusp of just a great moment. This is exactly what they wanted. This is the market that they're building up for. Prices are quite high. Saudi Arabia is making as much money as it did back in 2018. And I don't expect them to raise, their output in any way whatsoever. I mean, even the White House, we've got our own reporting, is quite pleased with them at the moment, what they're doing. And obviously, OPEC has said that they want to be as dynamic as possible, and they will respond to price shocks if they come. So I don't expect anything out of the ordinary to come out of OPEC today.
I have to say, Ed Morris over at Citigroup expects them to double their output of 800,000 barrels. But I think the majority are in your camp, Nor, that we won't see that reaction. But I mean, how high do oil prices need to get in order to not only move OPEC, but start to have a pretty consequential effect on earnings to come?
Well, realistically, I think if we start seeing levels head towards the 90 to 100, that's a number that was far-fetched. I mean, a lot of the bigger banks there that were calling for this number earlier this year, they kind of pared back those projections, and now they're calling in a bit towards 80 and 90. I expect if we start seeing numbers that led to the 2008 financial crisis, that's when you're going to start seeing a few heads start to sweat. But realistically, until now, and if you look at this chart that we've got there in the moment, you can see the Saudi Arabia is comfortably making as much money as it did in 2018. So I don't expect them to go to 800,000, but it would definitely be a shock. And I'm the first one to mea culpa if that does happen.
Thank you so much, Nora Ali there, always with some great insight on the markets from our MLive team. Now that's it for the European Market Open Surveillance Early Edition. Up next, we'll speak again to Nora Ali to look at some of the market dynamics. We look at your stocks to watch, and of course the big one, Danny's trying to figure out what happens with Evergrande, and then inflation expectations. Look, we talked about stagflation. We don't really have some data apart from a little bit later in the week, so it'll be interesting to see how the markets position themselves on a Monday.
Exactly, and so far, not looking so great. This is how the markets are positioning themselves, down as much as 0.4% in some of these regions. So Francine going to walk you through early edition surveillance up next. This is Bloomberg.
inflation is hot at the core level. It's very unlikely they can get to that target.
We are seeing a lot of stickiness in terms of core inflation and the influence of energy prices in merchandise.
We are working with our supply partners to gradually improve this situation.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Electricity and gas prices surged more than 1,000% from spring 2020 lows. OPEC will discuss its protection policy today amid rising crude prices. The Tory conference kicks off in Manchester. Boris Johnson says Brexit Britain must adapt amid fuel and food shortages. And this hour we speak to the UK International Trade Secretary Anne-Marie Trevelyan and the Chief Investment Officer at Harris Associates, David Harrow. Two big interviews coming up. Send in your questions on IB Plus TV Go. Now, first, let's check in on the markets. A lot of focus, of course, is on stagflation, the words of stagflation, and then everything that's happening in China. So that's filtering through the stocks. You can see, actually in the U.S., we see pressure. Here in Europe, we also see pressure with the European stocks down some 0.2%. Now, we will get data a little bit later on this week, especially in the U.S. That could give us a good indication of where we see the most unlikely, or how we see stagflation developing. Natural gas, one of the main wall of worries, of course, ever higher. So we have the energy crisis. We're expecting OPEC today to have a better indication of what they will do to help with the demand. Right, let's go to the map, and I don't know whether we also have your biggest movers, but always good to look at industry sectors as well. First, the map here unchanged for the UK, more pressure actually on the FTSE and FTSE MIB in Italy and the CAC 40. Remember, the DAX in Germany, we're still waiting for that coalition to build to see who the next government will be. Now, European finance ministers meet in Luxembourg later today. Top of their agenda will be the worst energy crisis in years. Natural gas and electricity prices have surged to record highs, signaling the supply shortage is set to get worse as winter approaches. Well, let's bring in Bloomberg's Maria Tadeo, who joins us now from Luxembourg. So, Maria, how big of a concern is this for Europe as it looks to recover from the pandemic?
Yes, Francine, good morning. And, you know, going into this meeting of finance ministers today in Luxembourg, I'm being told it really will be about energy prices. This will be the big talker among finance ministers today for a number of reasons. Of course, we've seen and talked about on the show many times how both electricity and gas prices have been going through the roof pretty much every day. It's a new record high for the European benchmarks. European finance minister worried that this could lead to perhaps a slower recovery in Europe. And then secondly, of course, is the impact that this could have on the inflation and the household picture for many consumers in the European Union as we head into the winter. A serious concern away from the macroeconomics of this story is the social impact that this could have. We're seeing European governments take measures to try to cap the impact from the wholesale into the households. But according to our sources today, European finance ministers will discuss how best to tackle this together. We know that the Spanish will table a proposal that suggests perhaps that it's a European Union that should buy in bulk so they're able to compete with the companies and able to get this at a much more affordable prices. Again, it's not clear whether this will take hold, but it does give you an indication as to which countries worry about their supply going into the winter, but also that concern about social pushback as we enter the winter, Francine.
Maria, thanks so much. Maria Tadeo there with the very latest on Luxembourg and the European finance ministries. Now, switching over to America, progressive Democrats are looking for ways to rescue President Biden's stalled domestic agenda, opening the door to scaling back some social spending. Well, House Speaker Nancy Pelosi has set October 31st as a new target date to pass the infrastructure bill.
I'm telling you, we're going to get this done. It doesn't matter when. It doesn't matter whether it's in 6 minutes, 6 days, or 6 weeks. We're going to get it done.
Well, joining us now for more is Bloomberg's Bruce Einhorn. Bruce, I know you've been following the story very, very closely. I mean, if there are signs of progress in negotiations, where do we look for them?
Well, the key thing to keep in mind is that we've got two different bills. There's the infrastructure bill, and then there's the social spending bill, as you mentioned. So there's agreement on the infrastructure bill. The question is, will they be able to pass it without also passing the bigger bill, the reconciliation bill that has all the social spending in it? And so that's where the negotiations are taking place for that bill at the moment. So we have conservative Democrat Joe Manchin saying in the Senate, saying that he won't accept a price tag over 1.5 trillion. Pramila Jayapal, head of the Progressive Caucus in the House, says, no way are we going to go for 1.5. It's going to have to be much higher. We've heard from Alexandria Ocasio-Cortez, AOC, the progressive representative from New York. She said over the weekend, one possibility that progressives are considering is limiting the social spending to a certain fixed period, so 5 years, say, instead of for the full 10-year duration of the bill. By doing that, that could get the price tag down, which could then get them closer to an agreement.
Great, Bruce, thanks so much. Bruce Einhorn there, following all steam ahead at the negotiations over there on Capitol Hill. Now, uncertainty is looming as investors weighing slowing economic growth, persistently high inflation, as well as monitoring the latest on Evergrande. Well, joining us now with more is Eddie van der Velde from our Markets Live team. Eddie, thank you so much for joining us. So first of all, we need to look at the impact that OPEC could have on energy markets.
Yeah, absolutely. You know what? The bulls are really back in the oil market. We're seeing talk of $100 a barrel suddenly. But really, you would have to think that OPEC is going to pump into these rallies. We're talking about maybe 400,000 extra barrels per day that they're talking about. But the question is, how much is that going to impact wider energy markets, as you say? And you know what? Natural gas markets are going to be tight no matter what, unless we see Russia pumping and Germany approving Nord Stream and those sorts of things. I think the energy market remains tight, even if OPEC starts to put some pressure on the oil price.
Eddie, how'd you look at Evergrande? So I don't know whether it's, slowly going to be resolved, or actually we're still just at the beginning of what could happen.
It does slowly feel like with this latest talk of a possible offer of shares in a major transaction, that the Evergrande crisis may just be not heading for a disorderly meltdown, right? And that's got to be a positive thing for markets. It feels as if the longer this is a slow burn, the more it feels like it is under control and people have an opportunity to read into this. So it feels like the effect is fading somewhat in markets.
How much is riding on the non-farm payrolls this week?
Non-farm payrolls, absolutely very interesting.
The big one.
The big one, right? And particularly this month, because we had... If the market is right, they're talking about maybe 470,000 new jobs. And if they're right, that's the second consecutive month of below 500,000, which will be interesting. But you've got to ask yourself, is this really going to shift taper expectations? Unless this is a complete disaster, the market's going to say, well, the Fed's probably going to taper in November, and if not, then at the very least December. So I think intraday volatility is the worst that we can expect.
So I'm not sure when the shift happened that we start, speaking about sticky inflation to stagflation.
Yeah.
But does the policy response from central bank actually change if they're dealing with stagflation? Yes.
I think so. I think that's a much harder question for the central banks to solve, right? It's just so much more difficult to set policy just right. And really, to answer your question, it's the beginning of last month. With the last non-farm payrolls reading, that's when really, if you look at the story count on Bloomberg, the number of people that mentioned stagflation when they talk to us, that's when it went through the roof. And it's something that's back on the agenda. We're not quite there yet. I mean, we're not stagnating, and growth is still significantly positive, but it is becoming a risk.
Eddie, thank you so much. Eddie van der Velde there from our Bloomberg MLive team. Now, Smart Conversations continue on Bloomberg Surveillance Early Edition. Later on in the program, we're also live from Manchester at the Conservative Party conference, where we speak to the UK's International Trade Secretary, Anne-Marie Trevelyan. But before that, we speak to the Chief Investment Officer at Harris Associates. He's David Harrow. He'll be joining me on set very shortly. So send all questions to him. Just write on to IB Plus TV Go, or you can tweet me directly at Flacqua. This is Bloomberg.
dealing with that blackout risk, those energy prices spiking?
Well, in the first instance, we will manage it over the next while. I think the key agenda item for Ireland on the energy front is wind, and we've been great developers of onshore wind. The next decade in Ireland will be offshore wind, and we have streamlined our planning application framework for investors so they have certainty in terms of applying to invest in terms of offshore wind infrastructure in Ireland. So that will be a key agenda item of ours. And renewables, we have a very strong climate component in our government and in our government programme, and that of course is not disconnected from the energy agenda. And there will be challenges of that, there is no doubt, but we are making considerable progress.
Are you worried about the here and now? Are you worried about blackout risks? Are you worried about the amount of consumption data?
Data is taking up considerable demand in energy terms, but we have been robust in terms of meeting that to date.
Watch Bloomberg Surveillance to learn how to look at markets, how to look at trends, and how to look younger.
What do you think, John? Botox, or do I really need to get something done?
I think, Tom, if we just change the style up a little bit.
You think so?
Yeah,
You
drop
look great.
the bow tie. Drop the bow tie.
What, skinny tie?
Yeah. I always say, this is my line, whenever anyone in America has a go at me about a skinny tie, the older you get, the wider it gets.
Oh, really?
Until it becomes a bow tie.
This is a bow tie.
Until it becomes so fat, you just sort of...
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg. First word news. Here's Max Ramsey. Hi, Max.
Good morning, Francine. New COVID vaccines will be needed next year. That's according to the head of vaccine maker BioNTech, speaking to the Financial Times. He says a new formula will likely be needed by mid-2022 to protect against future mutations of the virus. He's warning new strains may emerge that can evade booster shots and the body's immune response. Philippine President Rodrigo Duterte says he's retiring from politics and won't be seeking the vice presidency in 2022. Prior to the 2016 election, Duterte also said he was retiring. He ultimately ran for president and won. The list of presidential contenders won't be finalized until mid-November. A massive document leak has revealed how world leaders and the super-rich hide money in offshore accounts. The International Consortium of Investigative Journalists has dubbed the almost 12 million files the Pandora Papers. They say beneficiaries of secret accounts include Jordan's King Abdullah, former UK Prime Minister Tony Blair, and former associates of Russian President Vladimir Putin.
This is a different leak from what we've seen before because, for example, in the case of the Panama Papers, the investigation was based on one offshore provider in Panama. In this case, we have information coming from 14 different service providers and law firms around the world from many different jurisdictions, from Cyprus to Seychelles to BVI, etc. And so this investigation and this leak really tell us how the system works, and it's not just about how one company operates, but really how offshore finance works across borders.
Japan's parliament has appointed Fumio Kishida as prime minister. He's set to reveal a new cabinet lineup as he looks to revive support for his ruling party. Local media say he's likely to call a national election for October 31st. Kishida was not the public's top choice for the job, so he now has to win over voters. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Francine.
Thank you so much, Max. Now, we're also looking at Tesla pre-market. Quite a lot of stories going on, not only on Facebook, but Tesla amping up its fight with actually Rivian, citing battery secret thefts. And you can see Tesla gaining some 1.6%. Now, Mohamed El-Erian has some advice for Fed Chair Jay Powell about tapering. Get going. The bond market influencer says the window is closing. Shortly, we discuss the markets with David Harrow of Harris Associates. This is Bloomberg.
didn't want our story to be ended by Taliban. We wanted to continue the path that we started, to continue to go for our achievements and to go for having our dreams to reality. So that's why we decided to leave Afghanistan and go for somewhere safe. We are concerned that what will happen to our home then. Many people are leaving, but there are still girls who have dreams. There are still people who have dreams, and we want countries around the world to help Afghanistan to have peace over there, so that the girls over there can have the opportunities to continue their path as well.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Inflation isn't going down. Inflation is hot at the core level. And you know what? If you do the pure statistical calculation, it's very unlikely they can get to that target. So they're going to be revising their end-year target up yet again. Inflation is a global issue, but I call them stagflationary wins because they need not result in a stagflationary trap if you get the policy adjustment.
Well, that was Mohamed El-Erian sending a stark message to the Fed Chair, Jay Powell, about tapering. Now, let's take a look at some of the stories we're following this week. This afternoon, we'll get U.S. factory orders for August. On Tuesday, French industrial output numbers are out. Then, on Wednesday, it's Russia CPI. Details of the data could determine the size of the next interest rate hike. And then on Thursday, we're scouring the minutes from the last ECB meeting on its decision to scale back bond buying as the economy recovers. On Friday, we've got U.S. jobs data, the latest figures on non-farm payrolls. So one of our top stories today, Evergrande's shares have been suspended in Hong Kong, along with those of its property management firm. That's after a report that Hobson Development would acquire a stake in the latter unit. Now, our chief China markets correspondent, Sofia Ortay-Costa, joins us now. So, Sofia, what's the latest? China seems to be looking to ring-fence the company.
Yes, exactly, Francine. Chinese regulators really doing everything to make sure that this huge debt crisis at Evergrande doesn't spill over to the rest of the property market, doesn't spill over to the economy or banking system. We had the PBOC pumping liquidity for 10 straight days in September, really making sure that banks are well oiled to keep on lending. Now, the stock suspension today was really interesting because it's the first time Evergrande shares are suspending throughout this whole crisis, Francine, and Evergrande hasn't requested a suspension of its shares since 2016, so it's very rare. We know for a fact that it's a major transaction that Evergrande plans to announce. Still no update on that. What we do know is a report from local media that Evergrande is looking to sell a stake in its property services unit. Now, Francine, this is Evergrande's most valuable asset. This is really its crown jewel in a very, very large portfolio of companies. And if we are to believe the report, again, no official confirmation from Evergrande, then it's looking to sell that a stake, a 51% stake, at a 28% discount. Now, if Evergrande's crown jewel is selling at a 28% discount to market value, you really have to wonder how else Evergrande's going to raise cash with all these deadlines for debt payments and coupon payments looming, including one today, Francine.
So, Sophia, if things actually stabilize a touch, what kind of timeline are we looking at? So what happens when with Evergrande?
So we do know that Chinese authorities have pushed Evergrande to not default, and when you get a kind of guideline from Beijing, then you really should follow it as a company. Now, not to default on its dollar debt means, of course, that 30-day grace period that was kickstarted at the end of last month when Evergrande didn't or failed to pay those coupon payments. That's 30 days. That includes weekends, that includes public holidays. It should be around the end of October. That really is the real deadline for Evergrande to not default on its dollar debt. Any kind of update that we could get on its asset disposals, we are expecting some kind of announcement either today or early tomorrow morning if the shares are suspended in Hong Kong. That could really show whether Evergrande is progressing on raising cash from these assets that it does hold. Again, the NAV unit used to be its most valuable asset. That market value has dropped about $80 billion since its peak. So time is really running out for Evergrande, and what the market is telling the company is that it really needs to solve its financial issues pretty soon, because the bond market is pricing in a pretty big debt restructuring, Francine.
Sophia, thank you so much. Sophia Orta-Acosta there in Hong Kong. Now, in a second, we'll get to David Harrow. I think he's just sat down, so I'm excited to talk to him about banks and, of course, the impact that Evergrande could have on global banks. But it's always a good idea to look at the market. So let's have a look at what the futures are telling us. Stocks and futures are falling at the moment, worrying about stagflation. I'm not sure exactly what happened in the last 10 days, but from rampant inflation and policy mistakes, we now look at stagflation and the fact that higher inflation could be also coupled with lower growth. Now, the market interview of the day, undoubtedly with David Harrow. I've been looking forward to it all week. He's the Chief Investment Officer at Harris Associates, portfolio manager of the Oakmark International Fund, a $27 billion fund that has returned 8% year to date. Its top 5 holdings include Lloyd's, Intesa, Bayer, BMW, and Daimler. So David Harrow is with us on set. David, yes, you've made it to Europe. Thank you so much for joining us. We're just talking about Evergrande, and actually I just want to start off the conversation. We're keeping you for 30 minutes. What is the ramification of Evergrande on global banks? Like, have you looked at, who holds what, and are you confident that it's not systemic and that banks will be okay?
Well, I think there will be certain situations where people aren't going to get paid back 100%. But of course, where the bonds are trading now certainly are reflective of this. I don't really anticipate systemic, but I do think there will be write-offs here and there. And, this is what happens when you have a somewhat over-leveraged property sector in China, and you don't really have the cash flows to support the valuation. So this will not be the first time, but I do believe it's containable. I do think they will be able to contain it.
So do you have figures that you're looking at in terms of defaults and who has exposure to what?
No, I mean, I've seen the various reports, from the street on who has what, and it doesn't appear that one outside of China financial institution is going to get slammed, abnormally hard. But, in China, of course, a lot of the banks that hold this paper are ultimately controlled by the government. So it's going to kind of go from one pocket to the next.
David, when you look at President Xi's, global ambitions, and at the same time what he's been doing in terms of regulation and cracking down, what does it mean for global banks trying to get into China? Is it too risky right now?
Yeah, I don't know if it's too risky. You just have to be very, very careful. I think there are areas which banks and financial institutions, through investment management products, through insurance products, through these types of things, but underwriting and who are you lending to has always been risky in China, because the resolution process of what happens when a loan goes bad isn't crystal clear. I mean, even in places like Italy, which has gotten clearer, by the way, isn't clear. And this is what always should cause banks to think twice about what they do in places like China, because you do need a legal system to resolve a problem when a debt doesn't get paid back.
So, but does it mean that you've had to look at some of the banks that you have exposure to that actually were thinking of going into either GVs or just betting quite heavily on China, and have you had to readjust that?
Yeah, we haven't seen a lot of that in our holdings of banks having exposure to Chinese credit, and which isn't abnormal, by the way, because most of the credit that's extended in China is by Chinese financial institutions, thankfully.
David, I have a lot of questions. So you're in Europe. So, you know, first of all, well done for making it over. Are you looking at adding to any of the European stocks? Does valuation look attractive right now when it comes to international and companies based in Europe?
Yeah, if you look around the globe, I do believe that European-based companies are probably selling at some of the more attractive valuations compared to, say, Japan or the United States. And especially since, you know, Europe is, I believe, about to confront a sustained economic recovery. And when you compare the recovery that we're going to see, some of it is pandemic related, some of it is some of these long-time political issues like Brexit that have finally, for the most part, have been cast off to the side. But a lot of these uncertainties, the German election was one of them that caused perhaps people to pause. And I think now uncertainty surrounding powertrains and automobiles in Germany, a lot of this is becoming more certain. And I think this will provide confidence for companies to invest and to hire people. By the way, where they can hire people, because there still seems to be a big shortage of people.
So what are you buying right now? Are you adding to any of your holdings?
Yeah, we do a combination of adding to some of our holdings. And then in the last year, as a result, you know, we were heavily exposed to financials, industrials, consumer discretionary. And starting April of 2010, they had a huge spike. So as we trimmed some of those back, we were able to recycle some of those trims into new areas where we've been able to find value, like healthcare, for instance. You know, if you weren't a healthcare company directly involved in a COVID treatment or a COVID vaccine, you kind of lingered because your business was slow, because there were less hospitalizations, et cetera. So we found some good opportunity in the healthcare space, as an example.
Any big names? David, sir, are you, I mean, the way that you're thinking, I know, and I want to ask you about Credit Suisse, I want to ask you about Greensill, and the raids on it, and Lloyd's, but are you trimming some of the exposure to banks to make up for it with healthcare?
Yeah, but in essence, our mechanics are as follows. Step one, determine the intrinsic value of a business.
Right.
Step two, if price and value have a wide spread, you know, it becomes a bigger position. As that spread narrows, it becomes a smaller position. And of course, the hope is that we're invested in businesses that are proactively building value per share. So even if price doesn't move, the gap opens. So if in the last year you've had, or the last 18 months, this huge spike in price, the movement in price being at a quicker pace than the movement of buildup of an intrinsic value, for us that becomes a trim. It doesn't mean we've soured on the company. I mean, some of the auto stocks, for instance, we've trimmed back upon a little bit. They're still big holdings, as you mentioned, because that gap is still big, but it wasn't as big as it was. So the mechanic is that spread between our measurement of intrinsic value and price. And as it gets closer, we trim. As it gets farther, we add. And what has happened is we've trimmed back, and we've added to some of the healthcare names. Mm-hmm. We've added to some of the IT services, a company like SAP as an example, or Capgemini. These were companies that, oddly enough, didn't quite benefit from the glow of COVID, even though they were tech-related.
Talk to me about Credit Suisse. So first of all, there was this raid in the Zurich offices in a probe related to Greensill. Credit Suisse says, look, they're not involved in the probe, but still the offices were raided. Are they?
Well, they said they were. I mean, I only read what you read, and I think they'd be very cautious to say. And I mean, it sounds like they were looking for maybe a person's documents, or maybe they're looking at an individual. But the Greensill, the Archegos, I mean, these are things that were, I think, on the watch of past management. And I think numerous steps have been taken since then. As a result of the new chairman coming, I mean, I did not hide my opinions on previous chairman. And I'm very, very gratified that the person on top of this organization is extremely capable and understands risk control. I mean, look how he turned around Lloyd's and so on and so forth.
Both the chairman and the chief executive, do you have confidence in both?
Well, I think it's the chairman's job and the board's job to put a chief executive in place that is capable of building value for shareholders and running the business appropriately. And I think at this stage, as you've heard from the chairman, that he's confident that the current CEO is capable of doing this. So we have no reason at this time to question that. He has the most direct viewpoint of this, and again, I'm very confident that his judgment would be sound on this issue.
Dave, talk to me a little bit about whether you think Credit Suisse can actually stand alone, or whether in a couple of years it could be taken over even by UBS.
Yeah, I mean, clearly there has been interest in bits and pieces of this business. But, I don't believe that just, picking it apart is the right thing to do, because there is strength in the business model itself, the private bank and the investment bank. Of course, the problem has been is they haven't been able to, focus on the areas in the investment bank where they could earn a through-cycle appropriate return. That's number one. And number two, they haven't been able to properly control risk. And if you could do those two things, I think there's no reason why Credit Suisse can't exist as it exists today, but with improvements. If they can't do those two things, then you have to look at other options. I mean, clearly, they don't have the scale that some of the big U.S. players do in the investment bank. At some point, you might want to think about, are there things you could do with a UBS or with someone else to bring that scale and competitiveness to Credit Suisse?
But overall, you're content with the strategy laid out by the chairman, and are there any units that you would sell off at Credit Suisse?
I think at this stage, let's let them go through the businesses bit by bit to see where they do have competitive advantage, where they do have strengths, where it does make sense to be in the group where they can, as defined by, in a risk-controlled fashion, earn an appropriate return through the cycle.
David, you also own quite a lot of Lloyd's. 2 months, the chief executive has been there. What do you make of him?
Well, I've met him once and had a phone call with him once, and I think he's the right person. I mean, Antonio has done a great job at turning the bank around. He's been there almost 11 years. He did everything that was needed to put it on very, very sound footing. And I guess the next step, now that you're in this strong position, how are ways we could perhaps maybe grow a little quicker? There are ways we could create even more value. We can leverage those strengths. And I think the new CEO, Charlie Nunn, is in the right position, has the right mindset to do that while maintaining the risk controls. Remember, with banks, we have to maintain risk controls. We have to maintain cost control. And I believe that they have selected the right chief executive in order to do this.
How much do you think fintech will actually disrupt banks here in the UK?
It will continue to disrupt, but don't forget the big banks can be some of the biggest beneficiaries of that if they use that. A lot of these small individual fintech companies might have the technology for a little product here, a little product there. But let's not forget, this is a very, very regulated area. And you just can't come waltzing in and do whatever you want to do, though some of them think they can. And the banks themselves, I think, have the clients and they have the ability to pick and choose which fintech companies to partner with and which or to buy or to utilize. So I don't think it means the death knell to the big banks. If it was a free-for-all, if the ease of entry was there, I think maybe there would be a bigger competitive risk. But today, you don't have that ease of entry. This is a highly regulated area, and the regulators are very concerned, of course, where money's going and who has what and what they're doing with it.
David, thank you so much. David Harrow there from Harris Associates stays with us. We'll talk a lot more about some of his other investments. We'll stay on the banks. We'll talk about, of course, some of the commodities and also inflation, whether it's running hot. Smart Conversations continue on Bloomberg Surveillance Early Edition. Up next, we're also live from Manchester at the Conservative Party conference, where we speak to the UK's International Trade Secretary. This is Bloomberg.
on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
I support the new framework.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the Chancellor Rishi Sunak set to unveil a £500 million jobs plan as the country braces for a tough winter. This as the government faces growing concerns over fuel shortages and a cost of living crisis. Well, the CBI President, Karen Villamoria, spoke to Bloomberg earlier this morning.
Desperate times are now where we do need not just lorry drivers, it's butchers, it's welders, it's in the hospitality industry, it's across the board that there are labor shortages. And so if we can address them from a temporary point of view, that would help the situation. But of course, the long term, you've got to reskill. At the CBI, we've estimated 9 out of 10 people will have to reskill over the next 10 years.
Well, in the past few minutes, the UK Minister for EU Relations, David Frost, has also said that triggering Article 16 of the Northern Ireland Protocol may be the only way to protect the country. As a reminder, Article 16 would allow parts of the protocol to be set aside. Let's get straight to my colleague, Tom McKenzie, in Manchester at the Conservative Party conference, where he's, of course, joined by the Trade Minister. Over to you, Tom.
Francine, thank you very much indeed. Yeah, let's get straight to our next guest. Very pleased to say we are joined by the UK Secretary of State for Trade, Anne-Marie Trevelyan. Thank you very much indeed. I want to get to your priorities. You've taken over this portfolio just in the last few weeks or so, and I know you have a determination to work through some of the trade questions facing the UK. But I also want to start by asking about what's happening on the ground now in this country around the petrol shortages that we're seeing. Labour constraints are part of this. We spoke to the president of the CBI a little over an hour ago. He pointed to the labour constraints not just affecting HGV drivers, but many sectors of the UK economy. How much damage do you think this is doing to brand Britain globally?
So I think one of the challenges we're seeing is it's not only in the UK that we're seeing all these disrupted supply chains. We're seeing it across Europe and indeed across many other countries across the planet, because the great challenge that we had in having to shut down so much of our economy through COVID to protect everybody's health and anything that was non-essential was that we have disrupted everything, and that is now starting to come back. But there are some real challenges to getting that right, where people went home who had been living in the UK for to be with their families, to be safe through COVID. They haven't necessarily come back to the UK, and we are working to that. But it's been great. So as I was the energy minister before I took over as international trade, one of the key planks in our resilience networks was op-escalin operators. It was if there is a problem in the fuel supply chain that the military can be brought in to support the need to move.
This has been exacerbated by Brexit. I mean, it's pretty undeniable. It's not the sole cause, but Brexit has exacerbated this problem.
So one of the challenges, and there are many that we could go through if you wanted, Tom, is in terms of the age range of HGV drivers. And I think actually one of the interesting things which became highlighted through COVID was, we all championed and were hugely proud of all those in our health services who were looking after us through COVID, who were unbelievable strain. But there were so many key workers, of which a key group was the HGV drivers, who were quietly putting themselves at risk day in, day out to get things moved around. But that age range is of one where some have moved across. And I was talking to Chris Heaton-Harris yesterday about some of the shifts in where people have changed their workloads, because HGV driving is a hard job.
I am asking the Brexit question, of course, because you have been a champion of Brexit from day one.
I have.
A YouGov poll coming out suggesting the majority of people now are disappointed, disaffected by Brexit. When are we going to see the benefits of it, would be a question.
So I think we are already, and certainly within the new portfolio I've taken over in international trade, this is one of the areas, really exciting areas, where as as we help businesses to grow and to look to sell their goods and services across the world, international trade's role is to help make that easier and indeed to rocket boost that so that we can see not only the benefits in jobs and levelling up across the country, but the wealth that greater exports brings.
UK business is currently being affected by checks going into the EU, but EU products not being checked as they come into the UK, so there's a disadvantage for UK businesses. How long do you expect that to continue?
So we've just launched last week the Export Support Service, which is there to support our businesses who are having, various hiccups or indeed are wanting to export into European markets, and that's just launched, and I hope that businesses will be taking up the opportunity to make use of that. But we have not put the same limitations on products coming into because we are a free trading nation. The Prime Minister has been really clear that is what the UK is going to be going forward. That's what Brexit means. It frees us to be genuinely a free trading nation, standing on our own feet, wanting to reach out to the rest of the world, and we will be continuing to do that.
How much disappointment is there within your department that the US and the Biden administration seems unwilling to go ahead with a trade deal, at least in the near term, with the UK?
So I don't think there's disappointment. What we have is with a great relationship, so I've already spoken to my opposite number, Catherine Tai, and I don't think you're wrong. I think they're very focused on dealing with some big domestic issues, but that doesn't stop those conversations carrying on across a number of states, and I'm going to be going out to the states later in the year and talking to particular sectors, talking to those in Texas, in California, and New York, to talk about how we can do many of the things we want to do. If you look at one of the issues we had, there was the tariffs that have been put onto a number of British goods because of the Airbus-Boeing dispute. We've been able to release that, so it doesn't need a comprehensive trade deal to release what were tariff barriers, and that's taken those away. So there's a huge amount that we can do whilst we work towards a comprehensive trade deal in due course.
Is that possible, do you think, a comprehensive trade deal with the US before the next UK election?
So the answer is I don't know yet, but I hope so. I think that's the sort of time frame that's realistic. Not to the question of if you're telling me the election's in next year, then probably not. But I think absolutely we need to be looking at that. But in the meantime, we're looking to, across the piece. It's a huge market already. It's our biggest market. How we can release some of those pressures and help our businesses to do more quickly, long before we have a comprehensive trade deal.
Can you give us an update on the conversations and negotiations around the Trans-Pacific Comprehensive Partnership and where the UK is placed in that?
Yes, so this is a really exciting new opportunity for the UK. So we applied formally. You kind of literally write a letter of please may I join, and we were approved to go into the process. So we are at the moment knee deep in that very processy part, which is answering a series of questions from the CPTPP Secretariat. What does your legislation do in this space? How would you meet this requirement? So we are the officials and the lawyers are going through that with the CPTPP teams, and hopefully that will be completed by Christmas, at which point then we can hopefully move into the next stage of those final negotiations.
Should the UK be pursuing a trade deal with China?
So I think that's, we have an enormous amount of trade with China already, and that's a conversation that we will continue to have. I've had a lot of activity going on with my work through COP26, looking across the energy piece with China at some different levels. There are so many different networks where we are in discussions with China on all sorts of things. Our trade continues to be incredibly good with China in both directions, and that won't change in the short term.
Okay, Secretary of State for Trade, Anne-Marie Trevelyan, thank you very much indeed for joining us this morning at the Conservative Party's conference, the first one since 2019, setting out the priorities there for the UK and for trade and those trading relationships. Francine.
Tom, thanks so much. Tom Mackenzie there at the Conservative Party conference with Anne-Marie Trevelyan. Some interesting conversations about the Northern Ireland Protocol. Coming up, we continue our conversation with Harris Associates Chief Investment Officer David Harrow. If you have any questions for him, IB plus TV Go. This is Bloomberg.
China's growth because it is already slowing. Chinese manufacturers are curbing production. This is the latest shock to global supply chains, already delayed by, part delays, chip shortages, saddled with soaring commodity prices as well.
Well, Haslinda, when we've seen a lot of supply chain disruptions at the beginning of this COVID pandemic, and then, supply chains became resilient and it really moved goods around, especially medical goods and supplies. But now, at this part of the pandemic, we are seeing disruptions again, and discontinuities. And that is because of what we spoke about, the demand that is pent up. And of course, if you have factories slowing down and, not being able to produce as much, that is going to impact growth and the recovery.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now we're back with David Harrow from Harris Associates. He's portfolio manager for the Oakmark International Fund, a $27 billion fund that has so far returned 8% this year. In terms of sectors, financials make up more than a quarter of holdings, closely followed by consumer discretionary. David, we're talking a little bit about banks. We were talking about Credit Suisse and Lloyd's in particular. You were telling me also at some of the healthcare companies that you like. Is inflation here? Will inflation run hot? And are we going to see a correction in the markets?
Well, clearly inflation is here. I mean, if by any measure of producer price, consumer price index, GDP deflator, inflation is here. It's around the globe. I think some of it is cyclical as a result of the reopening and the inability of supply chains to keep up with demand. But I do believe that there is a structural component to this, and it has to do with the money supply that the central banks around the world are practicing. And frankly, and I write about this in my upcoming quarterly, when you have too much money chasing too few goods, you have pressure on prices. And money supply has been rampant. And as a result of a weakness in the velocity of money, we have not seen inflation. But I think especially given the capital positions of banks today, most global banks are overcapitalized. And with all this money out there, I think it will begin to get multiplied through the economy, causing an excess of money, causing pressure on prices. So I think at some point, sooner than later, the central banks have to look at reeling back their programs.
So, David, give me a sense of how much of a correction could we actually see in the markets? And what are policymakers, misunderstanding?
Well, in terms of a correction in the markets, I do believe that the markets today remain very bifurcated, meaning certain sectors are overheated, they have huge valuations with very little cash flow streams. And the excuse for this was, well, interest rates are so low, it really doesn't matter, because if you take the present value of money and you use a really, really low cost of equity, then it doesn't matter. But in essence, what will happen is, with inflation and higher interest rates, these streams will be less valuable. They're already small cash flow streams as they are. And then you have another part of the market, we'll call it the old school, financials, industrials, consumer discretionary. These businesses trade at very low valuations, and because interest rates were so low, people thought, well, why should I put my money in these stocks when I could put it in these go stocks? Well, I think what will happen is you will see a correction in these companies that aren't making very much money today, where there is hope that in 5 or 10 years they will make money, but the low interest rates will bail you out. But I think those are the stocks that are exposed in a rising interest rate environment. And what will happen is you'll see a rotation, a very strong rotation in the market to those stocks which make money, that sell at low valuations, which are the typical value stocks that people like myself populate their portfolios with. So I'm talking my own book, but the book is there for a reason, because we believe this is where value is in the markets today.
David, I know you've been a great student, of course, of U.S. politics for a long time, a donor to the Republican Party. What do you make of all of the machinations in the U.S. right now? As an international investor, does it actually make a difference to you, how much the infrastructure bill is, what happens to interest rates longer term?
Well, it is quite interesting because, as I was saying, that it's almost time for monetary policy to dial it back a bit because of what's happening with inflation, because already this global supply cannot keep up with demand. This is the same reason why, from a fiscal policy perspective, you have to start dialing back. And if anything, there should be policies to increase the supply side, starting with labor, in order to enhance economic growth. The demand side, we have plenty of demand. We don't need a $3.5 trillion spending bill in our country because we have adequate demand. What we need is supply. And the supply side economics says do things to shift that supply curve to the right. Simplify regulations, do things that help the labor market. We have record numbers of people not working today and record number of job openings. So there should be a policy that encourages people to get back into the labor market. So what we need are supply side policies today and not demand side policies, which is the exact opposite of what we're doing and will make this inflation problem worse. Now, thankfully, the U.S. political system seems to be working, because there are a couple Democrats who acknowledge this. I mean, Senator Manchin says inflation is a problem and the last thing we need is $3.5 trillion. So as long as we have this in place to protect, I guess, to protect and prevent us from economic insanity, I think, America will be okay.
David, are you a crypto believer at all? I don't know if I've ever asked you that.
You never asked me, but look, my background was monetary economics when I studied in graduate school, undergraduate. And money's supposed to be a medium of exchange and a store of value. And I don't think crypto's either of those two things. It can't be used as a medium of exchange because it goes up and down by 5 or 10% every day. And it's not a store of value, almost for the same reason. And you have a number of government authorities, starting with China, and not just China, by the way. If you heard the SEC chairman a couple weeks ago, the United States, governments don't like anonymous flows of money bouncing around from border to border. And so I view crypto as more of a trading device than anything else. So I'm not a big believer in crypto because I don't think it satisfies either of those two characteristics. It's not a store of value, it's not a good store of value, and it's not a medium of exchange. So what is it? It's a device for trading, I guess. And this won't be the first time there is a good tool for traders.
David, thank you so much. So good to speak to you after many months. David Harrow there, Chief Investment Officer at Harris Associates, joining us this morning. Bloomberg Surveillance Early Edition continues in the next hour. We'll have a full roundup of the markets, European stocks, U.S. futures declining. This is Bloomberg.
Electricity subscriptions, it's a part of this new business area that we have called the clean energy services. So the purpose with this new business area is to contribute and to create this biggest movement in the world for renewable energy. We will add even more products. We have solar panels that we sell, and now we have the electricity subscription. So it really fits that ambition that we have to, within the frame of life at home, the most important place in the world, we can add more value to our customers to live more sustainably. And this is a big part of the climate positive strategy that IKEA has for 2030, that we will remove and reduce climate emissions more than we emit in our entire value chain.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Inflation is hot at the core level. It's very unlikely they can get to that target.
Inflation will settle at a higher level than what we've been used to the last couple of decades.
Our key reasons to be constructive are still there, so I'm probably going to stay in by the deep camp.
This is Bloomberg Surveillance, early edition, with Francine Lacqua, Matt Miller, and Keely Lines.
Well, it's 10 a.m. here in London, 11 a.m. in Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Monday, October 7th. Our top stories today. Progressives to the rescue. Liberal Democrats tried to save President Biden's economic agenda by offering to scale back some of the trillions of dollars in spending. OPEC Plus plots its next move. The cartel and its allies meet to discuss how much to increase oil production next month. Conservatives at the crossroads. British Prime Minister Boris Johnson parties gathers this week at a time as a country faces its toughest winter since the 1970s. I'm Francine Lacqua here in London. Danny Berger with me in London. Keely Lines in New York, and Matt Miller is off this week. Keely, we're actually definitely October 4th. I keep on getting mixed up because we're like in a countdown to Halloween. But the market's being spooked out by inflation. They're, of course, looking at growth prospects, and they're on edge.
Yeah, absolutely right, Francine. Markets in Asia really starting off on the back foot this morning. We have to remember China is still closed for the Golden Week holiday. So anything you see on Map Markets Go that tells you China's in the green, that's from last Thursday, the last trading day when markets were open. Markets were open, however, in Japan, South Korea, and Hong Kong, and stocks down broadly across the board between 1% and more than 2% in the case of the Hang Seng. There are a few individual equity stories that are worth noting, one of them being Evergrande. Shares were halted in Hong Kong trading pending an announcement. Its property services unit also halted. Reportedly, that announcement is that Hobson Development is buying a 51% stake in the property services unit. That could provide some much-needed liquidity relief for Evergrande, which, of course, is heavily in debt. Another individual equity story to talk about is really just pharmaceutical stocks and vaccine makers specifically across the board in Asia, one of them being Shanghai Fosun Pharmaceutical. Shares down 19%, and that is off the news we got on Friday that Merck's experimental COVID-19 pill cuts the risk of hospitalization or death by 50%. Now, in other asset classes, I would point to iron ore futures up a little more than 2% in Singapore. Maybe some optimism that the steel mills will get going again after the holiday. And I would just point as well to the New Zealand dollar. It is an underperformer in G10 today, though it has gained some strength back. Right now, stronger against the dollar by about 0.1%. But Auckland extending its lockdown due to a COVID-19 outbreak. Now, here in the U.S., not a great start to the Monday morning as well. Futures are in negative territory, but only down by about 0.25% on S&P E-minis at this point. And you're seeing selling in the bond market as well. Right now, the 10-year Treasury yield is essentially flat after being higher earlier. Still, though, we're hanging out north of 148. I would point to oil as well. We are awaiting the OPEC Plus output decision. Ahead of that, oil down about 0.2% on WTI to 75.74 a barrel. And Bitcoin, of course, we saw those massive gains on Friday. They mostly held over the weekend, but giving some of it back this morning, down about 1.7%, trading at $47,600-ish, Danny.
Kaylee, you know I like to give you a lot of grief when your board is all red and depressing, especially on the start to the week, but I'm afraid my view of the maps here in Europe aren't that much better. We are down for a third consecutive day here in Europe. In fact, out of the past 7 days, 6 of them have been lower on the Stock 600. Now, some of these losses have been easing as we've been going through the trading session. We're about 2 hours into the cash equity trading. We've seen in those 2 hours, the UK flipped to positive. In fact, this just happened in the last 15 minutes. We're only up 4 basis points. It's flat, but it's better than the rest of Europe. Some of the real pain emanating in Italy, which is down 0.4%. Some of these larger cap type indexes as well have also been underperforming. So there you'll see the DAX, the CAC, things like consumer goods that have to deal with these supply chain issues. Autos certainly have to deal with that, really are what's driving some of those losses. So let's flip up the boards on a benchmark level. We're looking at a Stock 600 down 0.1%, trading at its lowest in 3 months. Now, we are seeing some improvement when it comes to cable. This is a much welcome relief considering it's trading near a January low. It's now at 135.72. Still, the natural gas picture continues to move ever higher. This is really a momentous move, up 4%. This is at a record on a closing basis. Intraday last week, we saw this price hit $100, 100 euros rather. So we're under that, but still, it's this inflationary picture that is really concerning to investors, making them sell off equities. Because the question is growth going to match that inflation? Well, inflation certainly taking off. Break-evens in Germany, your 5-year, up about 2 basis points. This is the highest level on record for German break-evens. Francine, the concern is also that the limits of monetary policy mean that they're not going to be able to control this type of supply-side inflation.
Yeah, and actually we're hearing more and more from our, newsmakers, including Philip Hildebrand. We just spoke to David Harrow saying, look, inflation could be back with a vengeance, and now's the time to act for policymakers before it really gets out of control. Now, this is a look at what else is ahead today and this week. Japan will welcome a new leader as Fumio Kishida is sworn in as the nation's 100th prime minister today. OPEC Plus will hold a virtual meeting to review output policy amid the energy crunch. The annual Nobel Prize announcements start today with the winner in medicine set to be revealed. On Wednesday, Hong Kong's chief executive delivers her final annual policy address before her term expires next year. She'll reportedly offer bold steps to increase land supply in the world's most expensive real estate market. And then on Friday, it's a big one. It's the U.S. jobs report. Data could either help cement or deter the Fed's taper timeline currently set to begin as soon as November. Now, starting with some breaking news, and the Biden administration will directly engage with Beijing in the coming days to enforce commitments in their trade deal and start a new process to exclude certain products from U.S. tariffs. Let's get straight to Anne-Marie Herdern, our Bloomberg Washington correspondent, who joins us now. Anne-Marie, under this phase one deal, China was committed to buying $200 billion in U.S. goods, and they have not done so.
They have not done so. They've been behind that. Some of that is due to COVID, but really even before COVID, you could see China was behind on those numbers. And this is part of what we're going to hear this morning from the U.S. Trade Representative Catherine Tai. She's going to be giving a speech after months of review on the U.S.-China trade policy. We're finally getting a bit of a glimmer of where the U.S. thinking is. So first, Francine, they will enforce those commitments China made. Now, remember, this deal ends at the end of this year, so really just 3 months left. Second, she will be speaking and start engagement with China's vice premier, which is her counterpart. And then finally, they're going to start this process of potentially some exclusions, which they believe will help American businesses and consumers. And it comes at an interesting time because there are supply chain bottlenecks for the business community, as well as fears of inflation. But this speech coming up this morning is being very, very closely watched in terms of where the future lies between Beijing and Washington in that trade relationship.
Well, Anne-Marie, let's bring it back to domestic politics because we are still in a stalemate over infrastructure spending. And Representative Alexandria Ocasio-Cortez over the weekend said progressive Democrats in the House are willing to compromise on some of the more ambitious social spending to rescue President Biden's stalled domestic agenda. Listen to what she said on CBS yesterday.
One of the ideas that's out there is fully fund what we can fully fund, but maybe instead of doing it for 10 years, you fully fund it for 5 years.
So trying to get that price tag down from $3.5 trillion in some form, Anne-Marie. And meanwhile, Nancy Pelosi says we have until October 31st to figure this out. Is it really going to take another 4 weeks?
I think it'll take at least another 4 weeks. There are some people who don't think we're going to be voting on any of this until December. I mean, deadlines, come what you will. The reason why she said October 31st is because there's that transportation highway deadline because they only extended it this week for another 30 days. Again, they could kick it down the road for another 30 days. But you do see negotiations really starting to intensify within the party, as well as even some of the rhetoric between the very moderates of the party, the more conservative-leaning individuals as well, and the progressives. But what we did see on Friday was the President of the United States really try to set the path forward for this group. On one hand, it was a win for the Liberal Party because he said we're not going to have a hard infrastructure until we get the bigger reconciliation package, and that's what the progressives in the House were pushing for. On the other hand, he did say it's not going to be $3.5 trillion, and this is where the debate lies. What is that top number going to be? It's going to be somewhere between what Senator Joe Manchin has said his line is, 1.5, and where the Progressive Caucus says, which is $3.5 trillion. And the White House is really going to be at the center of these negotiations.
Anne-Marie, thanks so much. Our Anne-Marie Hordern there in D.C. Now to the UK, and the Chancellor, Rishi Sunak, is set to unveil a £500 million jobs plan as the country braces for a tough winter. Pressure is building on the ruling Conservative Party as it holds its annual conference in Manchester. Well, joining us now from the conference is Tom McKenzie. Tom, what are the big issues actually affecting the government as the party conference gets underway?
Well, Francine, you've been discussing of these, of course, this morning, and you've been discussing them for the last few days and weeks. Number one, of course, for households and for drivers across the country is the fact that we are in week 2 now of this fuel crisis. The military will be on the roads, if they're not already on the roads, across the UK today, helping to try to alleviate the pressure at the pump. Then, of course, you have the fact that energy prices are rising, utility companies are going out of business, and many shelves in many supermarkets across the UK are empty precisely because of these labour shortages that are impacting the forecourts of petrol stations as well. So supermarkets, some of them empty in terms of supermarket shelves, and then the price concerns around petrol. That is the backdrop to this party conference, the first since 2019. Boris Johnson came out of the weekend and pushed back on the suggestion that he relax visas to ensure that there are more foreign workers that can come across and take up some of the slack in terms of that pressure in terms of the job market. He pushed back on that idea, said this is an adjustment process and that he wants to see a higher wage, higher skilled economy. But the short term, the pain is very much there. We'll see in his address on Wednesday what he has to say about it, but it is the Chancellor who addresses the members of the Conservative Party in the country in a little over an hour and a half's time.
On that point, are we going to expect the Chancellor to be talking more about taxes, as you say, when he speaks in an hour or so?
Well, there's a tension within the Conservative Party because there are those in the north of the country where I am now who want to see more spending on infrastructure, on healthcare, on education. There are those in the south of the country who do not want to see increased taxes to pay for that kind of spending. So that tension exists, and that's a tension that the Chancellor will have to address in his speech at around 11:50 local time. He's also expected to outline additional policies to help get people back to work. We had this furlough scheme that was supporting 11 million workers. That came to an end at the end of last month, just a couple of days ago. So what he's going to prescribe to help people getting back into work and help reskill workers is also something we're going to watch. And the Chancellor will be under pressure to address international investors. The pound, as you know, has been trading, some would argue, like an emerging market currency. The likes of Nomura coming out saying that they're going to short the pound, they're bearish on sterling. Others like Gavakol Research suggesting that the UK faces a recession in 2022. So Rishi Sunak will also need to address those concerns amongst investors.
Right, a lot to look out for. Tom, thanks so much. That's our Tom McKenzie in Manchester. And later this hour, Tom is going to be speaking with Lucy Fraser, the Financial Secretary to the Treasury of the United Kingdom. So stay tuned for that. Now, elsewhere today, OPEC Plus meets. It will be virtually as we see crude prices spiraling higher. So what can we expect? Let's get more with Helen Robertson, Bloomberg Energy and Commodities reporter, who joins us now. So, Helen, the target had been 400,000 barrels of oil added to the market daily. Are we going to expect an increase of that in today's meeting?
So what we're expecting is that OPEC is going to stay the course, essentially, that the group is going to continue with its current policy, because as we see, it's working for them. Crude prices surged to 3-year highs last year. Saudi Arabia, we now know, the amount of revenue that it made from crude prices is the highest it's been since 2018. So really, there isn't much of an incentive for the group to change its output policy at the moment. And bearing in mind what we know happened last year, oil prices went negative. The group's going to be very, very cautious about making any sort of extreme movements, because it's going to want to keep its revenue streams as stable as possible.
All right, thank you so much to Bloomberg's Helen Robertson there with a preview of the OPEC Plus meeting. Now let's get a look at some stocks moving in pre-market trading here in the U.S. And I have to begin with Merck, because of course we got the news on Friday that its experimental COVID-19 pill cuts the risk of death or hospitalization in half. The stock rose more than 8% on that on Friday, and the gains continuing this morning up about 3% in pre-market trading. That, however, is weighing on vaccine makers really across the board. One of them, of course, being Moderna, which makes a COVID-19 vaccine. That stock is down the better part of 4% today after losses on Friday. And finally, one more mover to the downside is Zim Integrated, the shipping company. Already it is down 6 consecutive days in a row, losing about 16% over that time. And it looks set for its 7th day of losses. The stock down about 3.6%, a major sentiment shift clearly for that stock, Francie.
Yeah, impacting shipping companies across the world. Now, coming up, we'll talk about shipping, we'll talk monetary policy and inflation with Callum Pickering, Berenberg senior economist. That's coming up shortly, and this is Bloomberg.
What have we learned from this ever-growing crisis so far?
From my investment perspective, I think diversification is very important. So far this year, we've seen many events, right? Maybe in the fintech sector, and education, casino, and property. So I think diversification help you lower your risk on your overall portfolio.
Medium term, though, are you seeing more risk and reward in the high yield space in Asia? I mean, how are you viewing this right now? Are there actually buying opportunities given just the selling we've seen?
This time is a bit different in the property cycle, because in the last, when you see there's a tightening measure, there's always demand there, right? Just the government trying to suppress the demand. But this time we're seeing a confidence issue, is like a buyer strike. Because of the sentiment, the evergreen is hurting the sentiment, and people don't want to buy. And other developer, because they want to get cash.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger with Francine Lacqua in London alongside Kaylee Lyons in New York. I want to talk about the duration trade, specifically investors paring back their exposure to that long duration. I have a chart with me. I also want to welcome our radio listeners as well. I know you can't see the chart, so I will explain it to you. What I'm looking at are daily flows of the iShares Long Bond ETF. This has about $6 billion worth of assets under management. And so you can see the daily trades do vary a lot. However, as Treasury yields have moved higher, as there have been concerns about inflation and perhaps even stagflation, we've seen investors exiting out of more duration type plays. So in equities, it shows up in tech. And in this chart specifically, again, for our radio listeners, the way that this is manifested is one big old red downward line of outflows last week. Now, not only was this ETF the fourth most sold ETF last week, at one point, we had the biggest daily outflows since March 2020. So this is about $1.2 billion worth of outflows. And here's the mark on March 2020. Again, for our radio listeners, it's just a lot of outflows over those two dates. So is it time to be worried about inflation, stagflation? Should you be paring back on duration? Let's get the view of our next guest, who usually is an optimist, but have things changed for him. It's Callum Pickering, Berenberg senior economist. Callum, thanks so much for joining us. So is the economic environment in the fourth quarter heading to one where you don't want to be owning these long duration assets?
The fourth quarter is going to be very tough. Big picture, still optimistic. Western households have seldom been in better shape, so this business cycle is set to be a good one. But the fourth quarter, there are several risks. China intensifying supply chain issues, COVID-related uncertainties, even US fiscal negotiations, and it all comes at a time when central banks seem to want long-term bond yields just to rise a little to temper the inflation risks, which seem to be a bit more persistent than once imagined. And this is all coming to a head in this fourth quarter. And with the higher inflation rates, we're going to get disappointing economic data. So this fourth quarter is going to be tough. And well, I'm left wondering if central banks want benchmark rates to be higher and the bond market correct and the equity market correct, will central banks step in and soothe the markets? Will it throw them a happy pill? Or will it actually say, no, the inflation data justify these higher bond yields, so we're just going to stand on the sidelines and see how it plays out?
Right. And so, Callum, what are you expecting exactly? Are you expecting a big correction in the markets because of all of that uncertainty?
I think volatility is probably a better description for what we'll see ahead, because on the one hand, I think we're going to look at fundamentals and say, this is pretty good. We want to buy assets which give us access to these future income streams that benefit from the stronger growth. But at the same time, we do have more inflation. We do have central banks sounding more hawkish, and analysts are going to be waking up to higher discount rates, which will mean those expected cash flows will be brought down. So I think we're in for a volatile period rather than a major correction. For me, the key issue is, do central banks have a good idea where they want bond yields to be at this current time? And for me, the key issue is, if bond yields rise so much that it would hurt the real economy, i.e. financial conditions are tightening too much, that will trigger the central bank intervention. But if they rise and central banks are happy, well, the market will be on its own.
That old, they're rising for the right reasons refrain. Callum, I'm starting to hear the word stagflation thrown around a lot. Do you think we're heading into a stagflationary environment?
Shouldn't be too alarmist. I think we've perhaps got a whiff of stagflation for, say, a quarter, 2 quarters. The economic data may be very soft in real terms, but against that, we'll have very strong nominal demand and rising inflation. But it should resolve once these global supply chain issues start to ease up. I think the big question is, how long does it take? Because earlier this year, when we first had these supply chain issues emerge, companies said, oh, this will all be over in 6 months. Now they're saying another 6 months, which means they don't really have good visibility over their supply chain. And central banks also seem to be making this 6 months bet. So I think there's some risks ahead.
Callum, thanks so much, as always, for joining us. Callum Pickering there, Berenberg senior economist. And coming up, Lucy Fraser, Financial Secretary to the Treasury of the United Kingdom. It's a conversation on the Northern Ireland Protocol and, of course, on Brexit. This is Bloomberg.
of the Greek economic debacle. What were you thinking about to make Greece recover as it has?
Well, Tom, we took over in July 2019 with a very clear mandate to make the economy grow again. We were hit by the pandemic, but we still managed to implement very significant reforms, and I think we used the fiscal room that was available to us to support the real economy. We're very encouraged by the recent data. The economy grew 16.2% in the second quarter of this year. We revised our forecasts upward to 5.9%, and this may be a pessimistic forecast for 2021. We see lots of interest for foreign direct investment by American companies, European companies. We're making big progress in digitizing the state. We have a very ambitious green transition plan. And overall, I think the mood in the country after 10 years of crisis has significantly changed.
Watch Bloomberg Surveillance to learn how to look at markets, how to look at trends, and how to look younger.
What do you think, John? Botox, or do I really need to get something done?
I think, Tom, if we just change the style up a little bit.
You think so?
Yeah,
You
drop
look great.
the bow tie. Drop the bow tie.
What, skinny tie?
Yeah. I always say, this is my line, whenever anyone in America has a go at me about a skinny tie, the older you get, the wider it gets.
Oh, really?
Until it becomes a bow tie.
This is a bow tie.
Until it becomes so fat, you just sort of...
How did you make the decision to move to the Bahamas of all the options out there?
We've been looking at the Bahamas for a while. They're one of the first countries to roll out any comprehensive regulation for cryptocurrencies, which we think is extremely important for the space and a really positive sign.
The growth story in cannabis remains very strong, even after the sort of loosening of the pandemic. There was a worry that there might be wallet spend competition, but so far the cannabis sector seems to be holding up very strong.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons in New York with Francine Lacqua and Danny Berger in London. Now let's get the first word news. An infectious disease specialist, Anthony Fauci, says the U.S. is turning the corner on the latest coronavirus surge. Still, Fauci told ABC News that more people need to get vaccinated to keep infections on a declining trend. He says the key risk is the 70 million eligible people in the U.S. who haven't gotten a shot. JP Morgan Chase CEO Jamie Dimon is defending his pay again. Dimon told Axios' HBO program that the bank's board decides what he makes. The board awarded Dimon more than $31 million last year. He said the CEO's compensation is part of a broader umbrella designed to retain senior management. Deutsche Bank reportedly dropped risky clients after the arrest of disgraced financier Jeffrey Epstein. According to the FT, the German bank looked at a number of wealthy clients with criminal records. Deutsche Bank said that the legal issues were different than those of Epstein. Epstein became a client in 2013 when he was already a convicted sex offender. And Wall Street is mourning the death of Citigroup's longtime chief U.S. equity strategist, Tobias Levkovich. He died Friday, a month after he was injured in a car accident. Levkovich was a frequent guest on Bloomberg Surveillance, and his market predictions and commentary were widely followed. Tobias Levkovich was 60.
Boosters work, and they will definitely help. The boosters, both the Moderna and the Pfizer booster, take antibodies back up to at least where they were, and probably twice or 4 times where they were at the peak. It's definitely teaching your immune system to recognize Delta better. The antibodies that people are making after a booster, they are better antibodies. And they're also probably then better antibodies at recognizing other variants in the future. If you get infected once, your immune system says, all right, here's how much I want to set aside of memory, right, to not get that again. You get infected twice, your immune system says, well, that didn't work, right? It should probably up that some. You get infected 3 times, your immune system is like, all right, this is a problem. It's really worth not getting sick anymore. And so the vaccines are essentially that, right? And if the immune memory was pretty good after the second one, what's probably going to happen after the third one is that it's going to be more stable. Even if the peak is the same, you're going to keep more of it for a longer period of time. It's a race, right? It's a race between the virus and your immune system.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua, Danny Berger in London, Kayla Lyons in New York. Matt Miller is off this week. Danny, a lot of the focus, of course, on the markets is on this inflationary pressure, which could turn to stagflation, and the market's really selling off.
Exactly, and I think it's really fascinating to look underneath the surface of these equity markets and look at energy really outperforming. This is not a classic cyclical type rotation. Andrew Garthwaite over at Credit Suisse saying that in a stagflationary environment, you will only see energy outperform. Francine, that's exactly what we've been seeing.
Yeah, we certainly have. Kaylee, how's it all playing out in the markets today?
Well, of course, the market is waiting for that OPEC Plus output decision, which could affect the performance of both oil prices and then, as a result, energy stocks. But it's interesting. While the stock 600 was lower earlier in the session, right now it actually is just fractionally in positive territory, up less than 0.1%. No, 0.2% at this point for the stock 600. But you are still seeing some of those more cyclical equities like banks really underperforming in the European session. Here in the U.S., futures are still in negative territory. We're down about 1/4 on S&P E-minis. We go nowhere on the 10-year Treasury yield, hovering right around 148. And as I mentioned, we are awaiting that OPEC Plus decision. Right now, ahead of that, after being lower earlier, Brent crude also basically flat on the day, trading at $79.27 a barrel. Now, of course, the news we got on Friday related to the pandemic actually maybe is a very good thing in terms of bringing us towards the end of the pandemic. Merck's COVID-19 vaccine pill, or just experimental treatment pill, reduces the risk of hospitalization and death by 50%. It rose on that on Friday, rising on that again today, up about 3% in pre-market trading. But Merck's gain may be a loss for other vaccine makers. Moderna, Novavax, BioNTech, all under pressure for a second day, down between 2 and 3.5%, Danny.
Well, Kaylee, I am solely focused on the UK. We have the Tory Party conference today that, of course, our Tom McKenzie is at. And in that light, it's interesting to look at what these markets are pricing when it comes to the BOE. And money markets are very, very hawkish. I want to welcome our radio listeners as well. Let me explain to you the chart I have next to here. Essentially, I am looking at money market bets on what sort and what timing of rate rises we'll get. This is for December 2022. So what this chart is showing us for our radio listeners is about 65 basis points of increases by the end of next year. Now, that is a very hawkish outlook. It implies a 15 basis point raise later this year, followed by 2 more. Now, the question is yes, inflation is high. Even the BOE has said we might hit 4%, but they think it'll come back down to 2%. And Andrew Bailey, the governor of the BOE, has said that basically tighter policy can't create more semiconductors, can't fix supply chain issues. So given this big ramp up in bets for how much the BOE will tighten, is risk now lopsided that we won't exactly see as hawkish of monetary policy as markets are expecting, Francine?
Danny, let's also get back to the UK Conservative Party conference in Manchester, where Bloomberg's Tom Mackenzie is standing by with a guest, and some of the dynamics, of course, that we're looking at the markets also playing out at the Conservative Party, Tom.
Francine, thank you very much indeed. Yes, we are, of course, leading up to the UK Chancellor of the Exchequer's speech. That's going to be at 11:50 local time. And with me now is the Financial Secretary to the Treasury, so of course someone who works very, very closely with Rishi Sunak indeed. Lucy Fraser, thank you for joining us on our set here at the Tory Party conference, the first one since 2019. I have to ask, of course, about what's happening outside of the conference halls in terms of the petrol crisis. We have the military on the roads helping to deliver fuel today. Do you have a clear understanding at the data that you see within the ministry as to the economic impact, the impact on businesses as a result of the fuel shortages, the panic buying, the labour supply shortages that we're seeing here?
Well, thank you. It's great to be here chatting to you now. Can I just pick up? Of course, it's really frustrating for everybody who's trying to get fuel, and I've seen those pictures in the paper and queues, and it's really, really frustrating. But you talked about it as a crisis. Of course, we do have sufficient supply from the refineries into the petrol stations. The issue is about spreading it around the country, and you will know we've taken a number of measures as a government to try and ensure that we do get the fuel, as you say, to those people who need it, who are working in jobs. So we've taken a number of measures, one of which is to ensure that the suppliers can talk to each other so that the petrol is going to the right places at the right time. You've mentioned the military. There's 200 officers going in to help ensure that the petrol is being supplied.
You're right. Those are the measures, but I just want to get a sense of where you sit within the Treasury working with the Chancellor, what your sense is of the economic drag of these supply chain issues and labour shortages, not just in the forecourts of the petrol stations, but in our supermarkets and more broadly across the economy.
Well, there are supply chain issues across the world at the moment. It's not just the UK that is being affected by this. So there are issues in other countries, not just in the UK. But
Brexit has exacerbated that shortage of labour.
Well, it is interesting because, we've talked about fuel, but obviously linked to that is HGV drivers. And we know that there are a shortage of drivers within Europe itself. What's happened is that the economy globally has contracted throughout the pandemic, and now businesses are getting up and running again, which is obviously fantastic for the economy, for individuals, for jobs, but that has an impact, and we're seeing the consequences of that impact. And of course, government has a role to ease the burden, and it is taking a number of measures to do that.
What are Treasury's forecasts for how long these supply chain constraints will continue to impact the UK?
Well, that will depend on a number of issues, and some of these are out of our control. So they impact on decisions that are taken in other countries, and issues that are happening in our country as well. So, we have taken a number of measures, but there is sufficient supply at the moment. It's about getting it to the right places.
Okay, there was the end of the furlough scheme here in the UK, which was supporting 11 million workers. That came to an end at the end of September. Do you expect a significant impact on those labour shortages as a result of the removal of furlough? Is that going to positively impact the labour constraints that we face in this country?
So you're right, we did have a large number of people on furlough, around 11 million, and that was necessary to protect those jobs in the short term. And the measures the Chancellor took were critical to ensure that we didn't have high levels of unemployment. So you will know that during the pandemic, the expectation and the trajectory was that we'd be looking at around 12% in terms of those who are unemployed. In fact, now we have under 5%. So That's 2 million people who could have been unemployed who are not. And what we need to do, and what the Chancellor is focusing on, is ensuring that people get into jobs so that we don't have those supply chain issues, so that we do get people into the right jobs. And during the pandemic, as we came out of it, he put in place a large number of schemes, getting young people into work, getting the long-term unemployed into work. And what he's announcing this morning is an additional 500 million to help continue so that we don't have labour shortages. We match people who are unemployed to the jobs that are available.
Will there be more concrete measures from the government to support industry, businesses, as well as households facing these energy cost pressures?
Well, the government supports industry in a variety of ways.
But will there be more measures coming? Do there need to be more measures?
To support...
To support industry and businesses that are facing these record high energy prices, gas prices?
Well, we have seen the government intervene recently in terms of the support that it provided a particular company to continue to supply. We need to ensure that the market works well to protect consumers. We have the energy price cap. What we want to ensure is that people get into the right jobs, people upskill and improve their own positions, that they get paid well for the work that they do, but also we need to improve productivity.
Okay. Can you rule out, Minister, additional tax hikes by this government?
Well, we took a really difficult decision in relation to the recent changes that we've made in terms of taxation in order to pay for the backlog in the NHS and in terms of social care. So you will know that the Chancellor and the Prime Minister, as Conservative MPs, would have found that decision extremely tough to raise taxes for working people, but that was a decision that needed to be made. And in terms of any future decisions, of course, I'm not going to talk about future decisions in terms of any budget that's coming up.
Okay, Lucy Fraser, thank you very much indeed. Financial Secretary to the Treasury, leading up, of course, to that in speech by the Chancellor of the Exchequer, Rishi Sunak, around 11:50 at UK time. Fran.
Yeah, I'm really looking forward to what the Chancellor has to say. Tom McKenzie there in Manchester for the Tory party conference. Now, coming up, we look at Bitcoin slipping again after Friday's gains. More on cryptos in general and on regulation next. This is Bloomberg.
如果佢唔係屬於呢個風險嘅地區咧，就全部由聽日開始咧可以恢復翻回港嘅安排啦。呢個計劃咧就將喺9月15日咧就正式推出，名額咧係深圳灣口岸同埋港珠澳大橋香港口岸每個口岸每日各1000人，咁即係話每天咧係合共有2000名非香港居民可以通過來港易咧係豁免檢疫咧係抵達香港。
Mistakes you've made or failures that you can talk about so that people could feel you're not just a superhuman.
People ask that question as if the only challenge is at work. Challenges come in a lot of different packages.
I think what we've seen during this period of time is that
communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Money's supposed to be a medium of exchange and a store of value. And I don't think crypto's either of those two things.
Harris Associate CIO David Harrow speaking earlier with Francine. And of course, David Harrow may not be a Bitcoin bull, but certainly the bulls were out on Friday. Sharp gains of about $2,500 per Bitcoin within minutes. Let's bring in Mike McGlone, Bloomberg Intelligence, commodities and cryptocurrency strategist. So Mike, we're back below that $48,000 this morning, but we saw a real breakout on Friday. What kind of technical signal can we derive from that?
Hello, Kayla. I think Bitcoin's established a new floor up around 40,000. Before it was 30,000 and that big correction. Now it's 40,000. It looks to me it's just a matter of time to breach 50,000 resistance. The market's a bull market. If it simply catches up to things like Ethereum, Bitcoin's going to $100,000. So what I see is increasing demand, increasing adoption, just a matter of time we get ETFs in the U.S., and supply is declining. And it's had it had a really good correction on things that are very bullish. China banning it is actually bullish in the long term. The issue with energy consumption is actually bullish in the long term. So I look at Bitcoin as just waiting for the next excuse to breach 50,000 resistance.
I mean, Mike, and good morning from London. What I don't, understand is that if you're a Bitcoin bear, actually, you're going to be a bear no matter what. What will it take for some of, actually a bull to turn bearish?
Well, that's kind of hard for a bull to turn bearish, Francine, but that's the key thing about Bitcoin bears. They were a high probability maybe a few years ago, and every single day that goes by, that bell curve of, that pendulum swinging to a Bitcoin bear is all turning towards bullish, like we saw from David earlier. I don't think he understands what's happening with Bitcoin and cryptos. Let's give you the example of crypto dollars trade on Ethereum blockchain, and they can trade 24/7, instant settlement, and you can earn interest much more than you do in euro dollars. That's all happening on the blockchain and with tokens. And then you look at Bitcoin. Bitcoin is clearly in the process of replacing gold in a world that's going digital. Digital reserve asset and the old analog. It's just a matter of time that continues. And I look at it as a greater risk are people who don't allocate to cryptos in Bitcoin, just a small percentage of their portfolios.
So what I'm hearing from you is, okay, boomer, it sounds like, Mike. I do wonder, though, in the argument when it comes to China crackdown, trying to make cryptos illegal, is this time different?
No, Danny, it's actually quite significant. First of all, how much worse is it going to get? They've completely banned it. I'm looking forward to the end game where they're going to have to cave a little and say, hey, there's not much we can do about open source software that's free market capitalism that trades globally, and it's one of the most unique examples of free market capitalism I've ever seen. So they've pushed back completely, and it's also really helped the mining issue. People thought there was too much mining concentrated in China. Well, that's not happening. Guess where it's going? Gas flaring in Texas and a lot of other places. So this is actually very bullish in the long term. In the short term, it caused a little bit of selling. In the big picture, it's quite bullish. And I'll leave you with this. It's really showing the difference in, the closed surveillance state versus the open discourse of regulation we're having in the U.S. at the moment.
Mike, I'm curious about the correlation Bitcoin has to other risk assets, because we're hearing growing calls for correction or some turbulence in the equity market as we head into year end. Do you expect that would translate through to Bitcoin if risk sentiment sours?
In the short term, today's a good example. Stock market's down, Bitcoin's falling, Ethereum's falling a little bit more. In the big picture, if the stock market goes down and stays down for a little while, what does that mean for debt to GDP and fiscal and monetary stimulus? It takes off. That's very good for Bitcoin and gold in the longer term. So I'm looking at this as a short-term headwind, longer term quite bullish for Bitcoin. And look at Bitcoin and the Bloomberg Galaxy Crypto Index. They've been way outperforming virtually every equity index, most notably for the last few years.
Mike, what are you expecting Gary Gensler of the SEC to actually do with Bitcoin and Bitcoin ETFs?
Well, that's the cool thing. Bitcoin ETFs that track futures are a matter of time. They have to approve those because there's so many ETFs that track futures and commodities. That's my space. You can't make those redundant. So that's just a matter of time. It's a baby step. And then we'll get to the more physically backed. But U.S., there's so many applications, and funds now are leaving the U.S., going to Canada and Europe. And I think Gensler and our regulators get that, hey, sorry, we're falling behind. Money's leaving this country because we're falling behind. We have to catch up. U.S. ETFs are a matter of time. That's part of the reason I'm bullish. Until we have wide dissemination of Bitcoin and Ethereum ETFs in this country, the market's more likely to have that dangling carrot of bullishness.
If that's part of your thesis on the bullishness of Bitcoin and other cryptos, what do you foresee in terms of price movement, the impact being of that approval of ETFs?
So that's what I think Gensler's doing a good job of. He's walking into it slowly. ETF futures, which we predicted months ago, have to happen. ETFs that tracks the futures, it's just based on the rules of a typical futures market. And then we get to physically back. But now there's over 30 applications. So to me, it's a matter of time. I don't know exactly when they're going to do it, but it's getting to the point where the demand's overwhelming. And then we also see a lot of ex-government officials going to the private sector. That's the way it works in this country. So I look at it as you can't push back on it much longer. And now it's time to recognize this as a new asset class. By the way, most of the other asset managers in the planet have done that.
Mike, thanks so much. Mike McGlone there of Bloomberg Intelligence. Now we'll have plenty more, of course, also on the energy crunch around the world. We were just hearing from the UK Business Secretary talking about the UK not using fossil fuel by 2035. Now, coming up, we'll have plenty more on that and the OPEC Plus meeting with Ed Morris, Citigroup Global Head of Commodities Research. This is Bloomberg.
What's happening on Wall Street?
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
I support the new framework.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Well, this is Bloomberg Surveillance, early edition. I'm Francine Lack with Danny Berger in London, Kaylee Lyons in New York. Tom Keene, also in New York, co-anchor of Bloomberg Surveillance. Tom, with an elegant elegant chart for us today.
Deep into October, let's get set up here, Francine, for what matters, and that is the earnings season start. David Wilson getting pumped up to do like 400 earnings reports in one day. And it's real simple. The Standard & Poor's 500, sum it all together. And if you take a given PE multiple, I use 20, JP Morgan with the optimism out at $240 earnings, and Morgan Stanley with some caution at 209. So 240 versus 209, and you go out 1 year, and that's the great divide, Francine, of where we're heading, according to Global Wall Street.
Tom, isn't it all about margin this quarter?
Yeah, I'm going to say it's about margin, but I really am going to go to the ratios, Kaylee. And, you know, the pros look at price to cash flow, price to EBITDA, and a bunch of other ones, even some balance sheet ratios. But the standard one is the price is compared to earnings. And that's the variable in that chart and in everyone's mind is what do you see in PE movement or margin movement, if you will, as you get out to whatever the fact is earnings will be.
I was going to say, Tom, I was looking at that Mike Wilson call, and part of it came down to the market not pricing in some of these supply disruptions. I don't understand how the market cannot be pricing that in when Mike Wilson was just on your show Friday. Surely the markets would have been awake to this.
Well, the markets are awake. John Farrow brought that up as well. I don't know what Farrow was thinking. He was like, you know, was thinking about English football or something. But the bottom line is, even if you quote unquote price it in, there appears to always be a market shock. You know, buying the rumor, selling the news has some validity to it, but there just always seems to be an adjustment after you see the fact, and you're going to begin to see that October, I believe, 13th with JP Morgan.
Tom, I think we had Bank of America actually predicting $100 oil, or certainly being a possibility.
Yes.
How much would that reprice markets?
Well, hugely. That is not in the market. There's no question about that, Francine. The glide path here from an 80 shock. I haven't even looked this morning. Brent crude's 79.37 right now. Francine, I use that London oil because I want to be invited over there to the LME meeting so you and I can hang out. But the bottom line is Brent crude's what I'm watching. And yes, Bank of America, and frankly, others migrate higher, 80 out to $100 a barrel.
Okay, come over. Also bring you on a field trip to the oil rigs over in the North Sea. We'll have a special edition of Surveillance.
I'm afraid of helicopters. I don't do helicopters.
Tom, it's all right. We'll go by boat. Tom Keene, co-anchor of Bloomberg Surveillance. Now, look at what else we're watching today. And actually, we continue with oil, Kaylee.
Yeah, I'm watching that OPEC Plus virtual meeting. Maybe their decision will get us closer or farther away from $100 oil. It's really going to be about how much output they decide to put back onto the oil market in November. The plan is 400,000 barrels a day. Some think they will stick to it, but some strategists saying they could actually go even beyond that, given how much tighter the oil market has gotten really in recent weeks as demand picks up and that supply remains constrained. So that will be what I'm watching today, Danny.
I was going to say, Citigroup's Ed Morris sees it doubling what the current output is. And of course, Ed Morris joining Surveillance in an hour or so. Well, what I'm watching is Rishi Sunak. He will be speaking. This is, of course, the UK Chancellor of the Exchequer will be speaking in about an hour's time at the Tory party conference. Two things on the agenda. One is a jobs funding plan, the UK bracing for a tough winter. But the second one that I think will be fascinating is Rishi Sunak's plan on taxes. He told Sky earlier today he can't rule out further tax increases. This could certainly be a rift that forms in the Conservative Party, Francine.
Now, what I'm watching out for, of course, is what Rishi has to say, also because there's something about the Northern Ireland Protocol, which frankly would be a declaration of war, analysts say, with the EU, and that has a whole loads of repercussions. I'm also watching Credit Suisse. Now, Credit Suisse, we found out today, was searched by police. At least the Zurich offices were searched by police last week. Some documents were confiscated related to Greensill Capital. Now, Credit Suisse was at pains at saying, look, they're not part of the probe. I also spoke to David Harrow, one of the biggest shareholders in Credit Suisse, and he says he is fully behind management, he's fully behind the chairman, and so for the moment he just wants them to, you know, have a chance at having a go at their strategy. Also, Kaylee, breaking news. I anchored with Danny Berger this morning for about 3 hours. She's been trying to peddle coconut milk in coffee. I feel like we need to look at coconut futures if this is the next new thing.
Coconut milk. I have to say,
I'll tell you, I got
in general, so.
Okay, see, this is good because I got two responses to this, Kaylee. It was, you're a millennial and you're an American. So I'm glad you can clear it up. It's not just millennial American.
I'm both a millennial and an American, and I veto that idea.
More Bloomberg Surveillance. Up ahead, we'll hear from Wendy Schiller of Brown University, amongst others. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Or U.S. Open tennis champion Emma Raducanu's 3 dream dinner guests.
Daniel Ricciardo, Michael Jordan, and then Tom Keane from Bloomberg.
She understands you.
Funny and very understandable.
I am reading in on tennis like nobody.
Yeah.
Champion approved Bloomberg surveillance. Mornings on Bloomberg Television and Radio.
What you're seeing in markets right now is a tightening. This is a tightening of financial conditions.
Economic data are all over the place because the pandemic has done strange things to the data.
You have to still worry about the service sector. You have to still worry about all those areas that are connected to travel and to leisure.
There's an economic wave, there's a delta wave, and we just sort of have to work our way through this.
It's been basically a rolling correction since March.
This is Bloomberg Surveillance with Tom Keane, Jonathan Ferro, and Lisa Abramowitz.
It is Payrolls Week from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keane and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market down 14 on the S&P. We're negative 1/3%, coming off the back of the biggest weekly loss since February. Tom Keane, this market, investors worldwide, gearing up for earnings season.
Gearing up for earnings season, I'm going to take that over payrolls. Yes, payrolls will be important, John, but I am to earnings. I like what John Stolfa says over at OPCO this morning, publishing moments ago, where he says, you know what, we get a sense of what lies ahead here with selective late reporters this week. Those names will get us to those big banks October 13th.
David Costin at Goldman, Tom, I think capturing the argument, the debate right now almost perfectly. The risk is that supply chain disruption persists and that these expected earnings that you could recoup in future quarters, that does not happen. Is this a story of recovery delayed or recovery derailed?
Yeah,
profits deferred or profits lost?
Yeah, I don't think we know. And it's going to go sector to sector and even company to company. Which sectors will get hammered by supply issues, which will not?
Payrolls Friday, Lisa, 470K, just a 500K spread.
Yeah, just that's
550.
it. That's it. It's also just the uncertainty from last month's payrolls report that came out so away from estimates. Look, when you were talking about what we're going to expect from margin pressures when we talk about earnings, I'm wondering what the implication is for the Federal Reserve, especially with so much turmoil amid the top. The idea here that do they raise rates or do they materially pare purchases even as the economy slows because of the inflationary pressures?
Are we doing Boston sports here or later, Tom?
Oh, no, we're doing it later. It's too emotional. I'll just fall apart.
Were you up all night?
It was a great weekend. I mean, the Tots took the trophy. The Tots looked lousy, John, in winning. I mean,
They did.
They won, but they didn't. The Aston Villas were sporting.
I watched season 1 for you, Nate the Great.
Did you?
You're proud. We can talk about that later.
Did you?
Futures down 12 this Monday
John
morning.
Farrell
Good morning to you all. Futures down about 1/4%. Bond yields 148.93. We are unchanged on 10s as we kick things off this Monday. Going into payrolls Friday. In the FX market, euro dollar 116.09. We're positive there. Leads to a little more than 1/10%. A stronger euro in the mix, reclaiming 116.
Yeah, there's not a lot of drama today. However, the nature of the ongoing concern about what happens, as you said earlier, of the idea of slower growth and higher prices is definitely weighing on markets. We're also looking at supply chain disruptions. Today at 10 a.m., we get U.S. factory orders as well as durable good orders. I'm very curious to see when you dig into the numbers what we're seeing in terms of people ramping up orders ahead of the Christmas season, as well as how long they have to wait to get those goods. We're hearing about potentially these store shelves being empty as people try to shop for Christmas. Today, we're going to be getting a speech from the U.S. Trade Representative on the China strategy. I am actually very curious about this because it sounds like the U.S. is going to crack down on China for not meeting some of its phase 1 trade goals. However, they're kind of stuck between a rock and a hard place. They need the goods. We have these supply chain disruptions. How do you work with China in this new regime where people are not willing to wait in America for what they want to buy? And then at 11:15 a.m., President Biden is planning to speak on the debt ceiling debate. Okay, a lot of people think this is not going to be an issue. The U.S. is not going to default on its debt. But I got to really raise the issue of we're kind of bumping bumping up against the deadline if you believe Janet Yellen's October 18th prognostication here. The idea here that the U.S. Democrats need 2 weeks to do it alone, to do the reconciliation. So then you start wondering, what's the deadline? Is it October 28th? But either way, we're bumping up pretty close, and people are starting to get maybe a little nervous, John?
We're getting closer. I imagine we'll get closer, Tom. Isn't that the base case for this kind of stuff?
Yeah, I read a couple articles.
Just bump up against whatever that
John,
deadline might be.
I'm not going to go there. What I will say, and I like what Greg Valliere published moments ago, everybody's focused on the big number on social spending instead of, are we going to get our bridges fixed? Are we going to get our tunnels fixed?
Yep.
John, are we going to get that railroad below the Hudson River? I don't know.
Something between 1.5 and 3.5.
No.
That's a social program.
Well, but
Lisa, no. What do you mean, no?
Because
It's not something between 1.5 and 3.5. It's not.
Progressives have actually conceded that it's going to be less than $3.5 trillion. And I think that's what we learned over the weekend, that basically there are going to be some concessions on that point. A lot of people saying that it was a win for moderates. We can talk about it later, but it seems
just an
like
impulsive no? Because it still sounds like it's 1.5 to 3.5.
it's still, okay.
Thank you, Lisa. You like that, Tom, that Lisa just says no, just throws
It's a Monday no.
I get
That's
it.
a Monday no.
Hugo Rogers joins us
Monday
now.
no across the kitchen table.
Dowtech Bank
Oh,
and
dear
Trust
Lord.
Chief Investment Officer.
I'll make you
It's
extra
the
coffee.
weekend with the kids, Tom.
100%.
Just spending no.
No.
Barry Manilow
It's
wrote a
okay,
song
Lisa.
about
Safe
that.
place. Safe place.
Is it?
Hugo, what do I want to own when inflation expectations are climbing and growth expectations are falling? I'm not saying we're there right now, but what do I want to own when that really starts to ramp up?
Well, I mean, we've been recommending for quite some time now, almost a year, to be owning cyclical value. It's not just as an inflation hedge, just because we could see pinch points and pricing pressure rising, we could see demand recovering. So cyclical value, the likes of energy companies, yes, and transportation and logistics companies, places where you see pricing, places where you see recovering demand, and actually significant relative underperformance, so plenty of safety in the value itself.
Hugo, what are you doing with big tech? Everybody's talking cyclical this, consumer discretionary, on and on, even the bank stocks. I hear very little chat about continuing to own profitable tech, cash-generating tech, or do you just get rid of it?
No, it's an excellent question. What do you do on the other side, exactly? The answer is that actually we've been very discerning. For a period of time, we've always categorized big tech into two blocks, really: the cash flow generators that you just spoke about, and then the tech unicorns, guys that just rely on 0% cost of capital, discounted into perpetuity, and therefore justifying sort of phenomenal valuations. And we don't really like those, because at one point in time, when the cost of capital isn't zero, suddenly they're worth nothing. Not quite, it's a very extreme example, but you can see what I'm illustrating there. So we've broken the big tech into those two, and even actually within the cash generators now, you're having to be quite careful, because like other sectors, they're suffering from input cost rises. Some are benefiting from the cycle, some benefited from the cycle earlier.
Yeah.
Amazon's been talking about rising input costs for a while. We're not as excited about Amazon as we are something like Alphabet, where search is actually a cyclical piece, so they're doing better on the top line.
I love how when we talk to stock analysts, increasingly they're talking about how they have to turn to rates, and they have to be rates analysts to have any effective call. And I do wonder, when you talk about cyclicals and the value stocks within them, how much this hinges on a Federal Reserve whose hand will not be called by some of the higher inflation reads that we're seeing.
I mean, Lisa, what an excellent question. The answer is that I'm in a privileged position to be a CIO, so I can spread my vision across different asset classes. And I think that's absolutely essential quality. You do need to be looking at rates. There is a very strong, and actually the evidence bears it out, argument saying that that lots of these large cap techs are actually duration proxies. In a world devoid of income, dividend yields are a substitute for interest income from bonds. So what the Fed does is absolutely essential, but also what it doesn't do. What has it not been doing all year? It's been ignoring inflation all year. Now its hand is being forced. So actually, it's interesting to see now that change in the bond market it's the foundation asset. It's how everything else is valued on a relative basis. And as the structure changes, as long-term inflation and interest rate expectations change, so will the pricing of all risk assets too.
Hugo, can I just get a final thought from you on energy? Just a fantastic week last week for energy equities on a week where the broader equity market was actually lower. Is that a position you're comfortable sitting in right now into year end?
Yeah, absolutely. In fact, it's actually one of our favorite positions into year end. We see supply bottlenecks really not unwinding. In fact, they're actually getting worse. China is talking about buying oil at any price, shortage of coal, natural gas cargoes, LNG cargoes are bunged up all over the place. It's a place where we've been thinking for a long time that this has been a very interesting and hot place with the return of demand. But it's actually, there's something else. There's another big piece of that puzzle, which is actually the lack of investment. You know, a lot of these physical industries have had a lack of investment for multiple years, and so actually long-term they're supply constrained. You're going to need excess returns on capital for a period of time. So we like it into the rest of this year and actually beyond as well.
The revenge of old commodities, Hugo. We heard that a couple of weeks ago, in the last couple of weeks, from Jeff Curry of Goldman. Hugo Rogers there, Dowtech Bank and Trust Chief Investment Officer. Hugo, thank you. Energy equities, Tom Keene just absolutely flying. That segment, that industry on the S&P 500 up for a third straight week.
Well, we had some churn at the end of the week, up fractionally today, 79.45 on Brent. John, I know you follow WTI. I follow the global Brent price, and at $80 print, you know what? It's on its way to 100.
Try and follow both,
according to too many.
75.97 on WTI. A little bit later in the program, we need to talk about Vice Chair Clarida as well. Lisa, another FOMC official getting caught up in all of this.
Yeah, he basically saying that he made these trades on a pre-programmed path. However, right before there was that surprise announcement by Fed Chair Jay Powell in February of last year. This really raises a question to me, John, and I'd love to hear your thoughts on this. Does this make it a lot harder for Jay Powell to get a second term?
Yeah, I don't know. I think it makes it a lot harder for Vice Chair Clarida. If you go through the timeline, Tom, the 27th of February, these transactions took place. The 28th, the chairman released a statement. Then a little bit later in the following week, on March 3rd, we got this unscheduled rate cut over at the FOMC. But it was pre-planned. The vice chairman isn't an active trader in this market. I think, Tom, they alluded to the fact that he made 5 transactions for the whole of 2020. But the optics right now for the broader Fed, I think that's the issue right now for Vice Chair Clarida. It's the timing of this discussion in the context of a broader discussion about what Fed officials have been up to.
We're going to break, which is probably well. John, you just said it correctly. It's the optics of the moment. I thought the coverage was total garbage.
Well, we can get to why you think it's total garbage.
I thought the headlines were irresponsible. They weren't trades, they were transactions. Farrow said it right, the headline said it wrong.
Well, Tom, we're going to come back. That's the perfect tease, TK. The story was garbage.
I thought the headlines were absolute garbage.
Tom Keene, Lisa Bramis, and Jonathan Ferro. Bob Dole coming up in the next hour. He is not garbage. 7 a.m. Eastern Time of Crossmark Global Investments from New York. This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. On Capitol Hill, House progressives looking for ways to rescue President Biden's economic agenda have opened the door to compromise. They have offered to scale back some of the more ambitious social spending by having those programs expire rather than become permanent. But they rejected Senator Joe Manchin's offer to cut the $3.5 trillion package to $1.5 trillion. Now, the Biden administration will directly engage with China in the next few days to enforce commitments to their trade deal. At the same time, it will start a new process to exclude certain products from U.S. tariffs in an effort to help American workers and businesses. One U.S. official says China may not change its trade practices, and the U.S. needs a strategy that takes that into account. Well, here in the U.K., Chancellor Rishi Sunak says he'll spend $678 million to help people find jobs. The government faces growing pressure to help struggling Britons. Household budgets are coming under strain after a cap on energy bills rose 12%, and the government is unwinding measures that did help workers and the unemployed through the pandemic. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
How is Ireland dealing with that blackout risk, those energy prices spiking?
Well, in the first instance, we will manage it over the next while. I think the key agenda item for Ireland on the energy front is wind, and we've been great developers of onshore wind. The next decade in Ireland will be offshore wind, and we have streamlined our planning application framework for investors so they have certainty in terms of applying to invest in terms of offshore wind infrastructure in Ireland. So that will be a key agenda item of ours, and renewables. We have a very strong climate component in our government and in our government programme, and that of course is not disconnected from the energy agenda. And there will be challenges of that, there is no doubt, but we are making considerable progress.
Are you worried about the here and now? Are you worried about blackout risks? Are you worried about the amount of consumption data?
Data is taking up considerable demand in energy terms, but we have been robust in terms of meeting that to date.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
We're going down from 6 trillion to 3 trillion. Now it's 1 trillion. And we have some of these conservatives that say, well, our line is 0, and you're lucky if you get 1. The agreement several months ago to even proceed on that one bipartisan bill was that it was tied with our larger Build Back Better agenda. Both of these bills need to pass. Both will not pass if people try to separate them.
Congresswoman Ocasio-Cortez there speaking on CBS. From New York City this morning, good morning. Tom Keene, Lisa Bramis and Jonathan Ferro. Your equity market this Monday morning shaping up like this. We're down 12 on the S&P. We're negative 1/3%. Yields a bit higher, curve a bit steeper on a 10-year. We advanced to 149, just south of 150 on 10s. Euro dollar positive, a little more than 1/10%. Stronger euro in the mix here, 116.11. That's the price action. Here's the controversy. I promised you we would return to it. TK is hesitant about going there. Tom, I think we need to have this discussion about Vice Chair Clarida. Pre-planned transactions on February 27th. I want to go through the timeline, which contributes to the optics, and I want to get to the facts and a statement from the Federal Reserve as well. Feb 28th, Chairman Powell issued a statement the day after these pre-planned transactions took place. March 3rd, we had that unscheduled rate cut. These are some of the facts, Tom. They are pre-planned rebalancing of accounts. The transactions executed prior to any deliberations that the Vice Chairman had with the Federal Reserve, according to a statement. The selected funds had approval of the Board of Ethics. It took place, these pre-planned transactions took place on the day that Vice Chair Clarida was visiting students in Yale. And the broader story for Vice Chair Clarida, it wasn't really that active. He listed 5 transactions for the year. So, Tom, they're just some of the facts around Vice Chair Clarida right now after the news late Friday.
Yeah, I thought Craig Torres' report was extremely well done. My issue, John, is the media using the word trade completely different than the way the street uses it. I don't see any trading here whatsoever. Trading is short-term, opportunistic, and what we really need to say, John, is what is the difference between, as you say correctly, the transactions of Vice Chairman Clarida versus what other selected presidents did? I don't know that difference. I got to see an article on that.
Both Kaplan and Rosengren, of course, Lisa. The issue at the moment for this Federal Reserve is the optics. And I think the issue for the people